Good morning. Thank you for joining us for the August 15th, 2024 meeting of the Chicago Teachers Pension Fund Board of Trustees. For the record, I'm President Jeffrey Blackwell, and this meeting is being held in person at our office at 425 South Financial Place. The quorum for this meeting is 7 trustees in person. CTPF has provided a remote access option for those who wish to attend virtually, and access instructions have been posted on our website. Please note the following. Trustees who wish to speak, please raise your hand and I will call on you in order. I've asked Vice President Price Ward to help me track the speakers. All participants, please wait to be recognized by the chair before speaking. I will ask for a motion and a second on the agenda item before any discussion on the merits. Please limit discussion from each trustee to 3 minutes unless the body consents to additional time. I'm going to request that a trustee not raise a hand to speak more than 2 times on any matter except to raise a point previously not raised or to answer a question. Please make sure debate is germane to the motion pending. I will entertain a motion with due respect for the length of the debate to close or limit debate to a period certain. I'm going to ask board counsel to assist me by pointing out if any of the adopted standing rules of debate are not being followed. Please be respectful of each other and allow frank and full discussion, but in an efficient manner. Our agenda calls for us to go into executive session. We will suspend our Zoom meeting and ask non-attendees to leave the room while we are in executive session. Please monitor the meeting online to determine when we are back in open session. For our staff and trustees to focus on the business of the meeting, we will not respond to messages from the public sent using the Zoom chat feature. If you have questions, please forward them to memberservices@ctpf.com or .org, I'm sorry. We'll now move to public participation. If we have anyone in the public that wishes to speak.
We have Tina Padilla.
Okay.
Good morning. Can you hear me?
Yes, good morning.
Good morning. I do not have the camera option, so I don't know if that's something you need to be aware of. Am I expected to receive another link with the camera so I could turn the camera on?
One moment, please. Tina, for a public participation, you're just allowed to speak. You're not promoted to a panelist anymore. Is she still there?
Okay, I got it now. Thank you. Thank you. The reason I'm here today is because I'm representing the pension advocacy group, and we're doing a lot of good work for our members. Before I start, and I always do this because we get a little technical difficulties here. Let me start by saying good morning to all of our trustees, executive director, and all fiduciaries present today. I want to start by giving you what my intention is today, but to bring awareness to a concept called capital cost of delusion. And that is my focus today, and why I'm here to again ask the trustees. My name is Tina Padilla. I did that already, and I'm sorry, I'm a little, because the process kind of takes me off. Sometimes I have a camera, sometimes I don't. I'm not going to waste any more time. On August 2nd, 2024, I again asked the trustee when the communications committee would be restored. On August 6th, again, I received a email from our executive director. And this is, he's responding. Thank you for attending the public meetings. In response to your inquiry, our trustees do not have plans to establish a communications committee. We have many opportunities for our members to communicate with our trustees and to participate in public meetings. And he outlined them in a previous email. Thank you for that, Executive Director. However, it is not meeting our needs. Last week, when I said we were being served up things we didn't order, and this is one example, prime example, why we need the communications committee back. We must be able to communicate with the representatives, our governance body. I sent out an email this morning, and I hope and pray that all the trustees I have two questions for you today. Would you please reply to my email today? And two, I didn't include this in the email, but this is what I'm asking. Would you please include any way you would like the pension advocacy group to directly communicate with our governance body? That is my presentation for today. Have a great meeting. Thank you for your service. Goodbye.
Thank you, Tina.
Erica Mesa. Erica Mesa.
Erica Mesa, okay. Okay, Erica,
Good morning. You all
Morning.
can hear me?
yes.
Oh, okay. Thank you. Thank you, President Blackwell. Good morning, CTPF trustees, consultants, and staff. My name is Erica Mesa. I'm a 25-year educator. I'm the chair of the CTU Tier 2 Pension Committee, and I'm the pension rep at my school. In reviewing the core fixed income search documents for today's meeting, I noticed some inconsistencies that raise important questions. Both Callan and CTPF investment staff emphasize the goals of removing all passively managed funds and negotiating lower fees. So both of those goals, removing all passively managed funds and negotiating lower fees, were part of today's documents. However, I'm concerned about whether these objectives can be achieved simultaneously. For example, one of the 4 finalists for from today's presentations for the RFP that was called out in April, Loop Capital, I want to compare their performance and fees to the Vanguard's total bond market index fund institutional shares. Over the past year, Loop Capital's performance in fixed income was 2.89%, while Vanguard's was 5.21%. Year to date, Loop Capital has a loss of 0.28% compared to Vanguard's gain of 1.69%. And for good measure, over the past 10 years, Loop has averaged 0.31% in the fixed income market, while Vanguard has averaged 1.60%. When it comes to fees, in their presentation for today, there are two sections where Loop could have shared their fees: in the proposed fees, and then again in the fees section, section 10 of their document. Both of those sections are blank. You have to go into the fine print to find Loop's expense ratio. Their expense ratio is 0.38% for the first 25 million, amounting to $950,000 in fees for a $250 million investment. So Callan in their document stated that we're looking into investing 250 million to 300 million in fixed income. So far for Loop, the amount of fees is $950,000 for the first 25 million. In contrast, Vanguard's fee is 0.035%, more than 10 times less than Loop's, resulting in just $87,500 in fees for the same investment.
I'm sorry, Erica, that's your time. Did you want to give us a closing thought?
My time? Yes, please.
Let me ask, is it the will of the board to?
I'm fine with it.
Okay,
Thank you.
okay. Mhm.
Okay. So resulting in 87,500 in fees for the same investment, a difference of 862,500. This significant disparity in fees not only impacts immediate costs, but imagine the long-term compound interest that we're losing on that money also, that difference in fees. I'm closing up, thank you. While actively managed funds might promise higher returns, index funds offer clear benefits with lower fees, steady performance, and less risk. Over time, these factors help our pension grow more reliably, making index funds like Vanguard's a smart choice for maximizing value for our members. Given these advantages, can we realistically justify moving $250 to $300 million to a 100% actively managed fixed income fund like Loop Capital or any AUM firm, considering both the performance and the substantial difference in fees? And finally, how does this align with our fiduciary responsibility to maximize value for the fund? Thank you for your time.
Thank you, Erica. Do we have any more speakers? Okay, that takes us to roll call.
Roll call, trustee Barajas,
Present.
trustee Beza,
Present.
trustee Blackwell,
Present.
trustee Nelson,
Present.
trustee Ochoa,
Present.
trustee Price Ward,
Present.
trustee Rodriguez,
Present.
trustee Benson,
Present.
trustee Washington,
Present.
trustee Woods,
Present.
that concludes roll call.
Thank you. We have a quorum as required by the Open Meetings Act, so we proceed with our first item of business, approval of remote attendance for our trustees joining remotely. And Mayor Sharon is joining her. Okay. The Open Meetings Act allows for a remote participation by a trustee if a quorum is physically present and a member cannot physically attend due to personal illness or disability, employment, public body, business, family, and other emergencies or unexpected childcare obligations. Trustee Riley will be participating remotely this morning. Trustee Riley, please confirm that you are attending due to one of the exceptions previously listed. Okay.
Okay.
Okay. Okay. Okay, we'll move on to 4, approval of today's timed agenda and fixed time for adjournment. I'd like to entertain a motion for for approval of today's timed agenda and fixed time for adjournment.
So move. Second.
Motion is made by trustee Price Ward, seconded by trustee Barajas, and roll call.
Trustee Barajas,
Yes.
trustee Beza,
Yes.
trustee Blackwell,
Yes.
trustee Nelson,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Rodriguez, trustee Benson,
Yes.
trustee Washington,
Yes.
trustee Woods,
Yes.
We'll move on to 5, report on committee of investments, and I will hand it over to Vice President Price Ward.
Thank you, President Blackwell. At this time, I would like to invite our CIO, Fernando Vincent, and Callan, our consultants, to come up to the podium. Our investment team will provide a summary and review the core fixed income search before we invite our finalists to give presentations. Our presenters will each have, excuse me 1 minute. Can we modify this 10 minutes and 10 minutes? Okay, all right, okay. So, and I'm asking that we modify the presentation period because we have had a history of questions and I want all questions to be answered. So I am having 10 minutes for presentation and 10 minutes for questions. Please hold your questions until the end so that each finalist has equal time to present. And as they come in, I will let them know that we will be holding questions until the very end. Thank you.
Good morning, trustee Price Ward and trustees.
Yes.
So the purpose of today's discussion and presentations is we want to finalize the core fixed income search that we initiated earlier this year. And some quick background as to why this search was necessitated. If you recall, we increased our target for fixed income from 23% to 26.5%. And at the time, we were actually under allocated. We were closer to 18%. So we needed to reallocate money. In addition, we also reconstituted the mix between core and core plus from 60-40 to 40-60%. So more money would be allocated to core plus. But within core, we had 4 managers and 1 was going to be moved to core plus. So that required that we replace the move. In addition, we are limiting the maximum allocation to no more than 20% of strategy assets. In addition, the other thing is, as mentioned earlier, we are terminating 1 passive strategy that's managed by State Street, and we're looking to also, if we can do it, increase usage of MWBE firms. For this search, close to 50 firms responded with their core fixed income product. We narrowed that down to about 8 to 10 semifinalists, interviewed 7, and then brought in 3, and also with an additional client request candidate with AFL-CIO. They've had stakeholder interest in because of their focus on affordable housing and having a strong trade union base. We thought it'd be worth hearing from them directly. But I will let Callan speak to all the candidates as to their backgrounds and possible fit with our portfolio.
Thank you, Fernando. Thank you, trustees. So as Fernando mentioned, this is a core fixed income search. And what we have here today is sort of, as you may see a theme with some of the things we're doing, is a little bit of a variety across the risk spectrum and the return spectrum. So we can not only compare, what the firm makeup, the size of the assets, but also their strategy and how it fits within this portfolio. So we thought the mix of managers here gives you a little bit of an idea of the space, and then
I got it. You're in.
She's in. That's good. And as well as, please. Okay. So I'll briefly go through some of the characteristics and some of the things, or would you like to allow her in now? Yeah.
Entertain a motion to, what to say?
She's got to say. Gotta ask her.
Oh, I forgot. Yeah, I'm trying to skip some stuff. We got a long day. Expedite some things. Trustee Riley, can you confirm that you are attending due to one of the exceptions previously listed?
Yes, I can. Illness?
Thank you. I'd like to entertain a motion to allow trustee Riley to participate remotely.
So move. Second.
Washington and Ochoa.
Trustee Barajas,
Yes.
trustee Beza,
Yes.
trustee Blackwell,
Yes.
trustee Nelson,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Rodriguez,
Yes.
trustee Benson,
Yes.
trustee Washington,
Yes.
trustee Woods.
Yes.
That concludes roll call.
Thank you. Sorry about that.
No, thank you. Glad we have everyone here. So really, I want to let the managers speak about what they do, but I want to give you a little bit of my view and Callan's view on some of the risks and some of the things we've identified. So the first thing I'll look at.
Tony, could you start over? So
Yes.
that we can
Yes.
have the consistency. Yes, please.
Okay.
Thank you.
No problem. So as Fernando said, with the fixed income structure review, we're looking at adding another core fixed income manager to the lineup. As you've seen, there's a theme here. We're giving you a little bit of variety of risk and return profile, as well as different types of firms that can provide this service for you. In addition to the three that we identified in our search, we also have AFL-CIO, which was a request. And it is an interesting comparison to these, and I'll go through that briefly. So the first thing I want to look at is page 13, and I think this gives you a little bit of a view of sort of the risk and return. That's the way I like to look at it at the beginning. First thing I'll highlight, the returns on the left-hand side, it's a pretty tight bar there. I mean, we're talking 1.6 to really 0.4. So this isn't 5% differences in returns. This is a relatively tight band of returns. And as you can see, the risk, is pretty tight as well, from about 6.2 to 6.9% standard deviation. So as with other searches where we're looking at equities or things like that, much tighter grouping of risk and return, which is what we would expect in fixed income. And if you can look at the far upper right, Merganser, higher volatility, higher return. And then the other red dot there, Bloomberg Aggregate, that's the benchmark. So you can see that the managers that we're bringing here, with the exception of AFL-CIO, are offering a little bit more risk and a little bit more return, which is what we would expect from an active management. So any questions, please feel free. The next page I wanted to look at is page 15. This is another view of risk that I like to look at, duration. And as we've seen, especially with interest rates moving, and this morning rates were moving again because a good consumer number came out. You see duration of Longfellow on the far right. That would be if you had to characterize it, the higher risk. More duration, as rates move, your portfolio will move more. And on the far left, you've got sort of AFL and Loop. And then the Bloomberg Ag is somewhere in the middle. Again, it's a relatively tight range. We're talking from 6 to 6.5 years. So this is a type grouping which we would expect in sort of a core fixed income strategy, but it does give you an idea of where people may be reaching a little bit for risk. Longfellow looks like they're pushing a little bit on the duration side. So that means their bonds are longer. So if rates move quickly, those bonds will move more than sort of a 1-month bond or a Fed funds rate. The real interesting page is page 17. And this I like because it's a great sort of graphical representation of what's in the portfolios. The bottom left is the benchmark. I'll explain, I'll highlight a couple of the colors for you, but basically the benchmark has corporates, a little bit of structured credit, CMBS, and then it's got treasuries pretty much. So that's what the benchmark is. If we go up directly above that, the closest I would say is Loop Capital. So they're closest to the benchmark in the assets that are in their portfolio. They've got a little bit more of the red, which is the CMBS, but not very much. And I would say that the CMBS and the non-agency RMBS, that structured credit stuff, that starts to get a little funky. So there's usually a little bit more leverage involved and a little bit more complexity in the bonds. And as we saw in certain circumstances, those markets can actually get tight and freeze up. So in 08 and in 20, those markets kind of got really quiet and it was hard to trade. Corporates and US Treasuries, those are the most liquid things in the world. So those always trade. So just to notice the difference of that red bar in these things does represent some potential illiquidity during a crisis scenario. So one of the things, actually, Fernando and I talked about this. I think one of the uses for a core fixed income is not only to provide return, but also to provide some protection in crisis scenarios. So 2008 happens again. We know our equity portfolio is going to go down. Hopefully not as much as the market because we've got great managers. But we expect our fixed income portfolio to really hold up. And the more you're closer to having corporates and US Treasuries, the better you're going to do in that scenario. So if I had to benchmark these, I would say Loop is probably the least risk of crisis, and AFL-CIO, and that's a different thing, and I think it's a really interesting one. But it definitely has that sort of crisis risk in there a little bit with the structured credit. And they all have a little bit of a taste of that. I would say it sort of goes Loop, Longfellow, Merganser, AFL, if you put them in a continuum of that sort of crisis risk. And I would say Loop, with the portfolio they have today, has the best opportunity to prevent losses in a crisis scenario. So I just wanted to sort of lay that out. And as they come in here and talk about their portfolios, you can listen for things, the basic fixed income versus some of the other stuff. The other stuff tends to be less risk protection in crisis scenarios. Don't want to focus too much on it, but it's always good to know what's in your portfolio because volatility can be like this until there's a crisis, and you don't see that every day. So good thing to keep in mind, what's really in the portfolio may have more risk than the volatility that you're seeing is portraying. Does that make sense? I went a little long, but it's something I think as we see these portfolios, there's the difference. And it's good to notice that difference as we talk to the managers. That is all I had prepared, but I'd be happy to answer any questions before we get started.
So one of the people in the public participation, I think they did what a lot of well-intentioned people would do, is they cherry-picked something. They don't know that the purpose of why it's there and when it's not going to be doing well. So you just explained that it's there for a reason. It may not look so great, but during a crisis, that's when it performs. Would I interpret that right?
That's a very good interpretation. And each one of these have a different level of that protection.
Thank you, Madam Chair. So also, I was going to say something similar to Trustee Ochoa, based on public participation. Can you set the record straight, Tony, just in terms of the fees on your last page of your slide?
So, are we in public? Because I don't know if that fee is.
We are in public.
Okay, so the one thing I will say is those fees that were referred to are standard fees for people that sometimes have smaller accounts. And Fernando and his team have negotiated a fee that's different from that, that is probably not in a public forum.
And just to add, Carlton, I just looked it up real quick. I don't know if they were referring to the Vanguard Core retail fund. That is at 20 basis points. So. We're bringing in the first presenters, Luke, right? Yes. Okay.
All right. Thank you.
No, I think they did a great job. This has been, we've taken an entire year to do this. This is a big restructuring for us. And I think it's part of the process that we've had in place for a long time. We've been very thoughtful and prudent about how we add and where we add. And we think with the new interest rate environment that we're currently in, that all of these steps make a lot of sense for us to improve what's already been a well-performing fixed income portfolio.
Good morning, welcome.
Good morning.
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 Yeah.
Should we start?
Yes, you may begin. We are going to hold questions until the very end because we want to give you every opportunity to present your full presentation. We're going to adjust it a little, and we're going to do 10 minutes for presentation, and then we will have 10 minutes for questions. We anticipate that we are going to have a lot of questions, so we want to leave time for that.
Okay.
All right.
Okay.
So at this time, you may begin.
Well, first and foremost, I'd like to thank the board for allowing us to present today. I see so many wonderful faces that we've known for quite some time, and you've been an amazing relationship of ours, even before the asset management opportunity came up, which we'll speak to. I'd like to basically, just lay the groundwork for CPS and Chicago, and how significant it is for us, not just to have a business opportunity to do business with you, but to really continue the tradition that we feel bound by, to be your partner. Our commitment to Chicago and CPS, you've heard numerous times, we've been with you from underwriting to the brokerage program, to our JLC fund, and to this, and you've heard me speak multiple times, and I'm really proud that in each of the times that we've reached out to you, the response has been positive. My own background, for those of you who don't know, and I'll be redundant, I was born here in Chicago. I'm from Inglewood. I've spent my entire 44-year career here in Chicago. I built Loop Capital Markets here in Chicago, starting with 6 people around with folding chairs and a card table, to now about 300 of us, and one of the most dynamic investment banks in the US, as well as some of the other businesses. In addition, our roots are very deep. I've gone my entire education from kindergarten through high school has been through the CPS system. Oliver Wendell Holmes, which I graduated from, 55th and Morgan, Chicago Vocational High School, I graduated from. And then when I graduated from college, Wisconsin and Kellogg at Northwestern, I started my career here and still been here since then. Our first transaction at Loop Capital Markets, I started Loop Capital Markets in 1997. First transaction we ever did was Chicago Public School bond underwriting. We've gone on to become one of the leading underwriters of municipal debt in the country. In addition to the commitment that we have to CPS and the students and teachers at CPS, we also have a strong commitment to the city. The profile of Loop Capital Markets in this city is probably second to no corporation in this city. And having been born and started and grown here, it's been significant for us to say that. My view of Chicago Public Schools and the work that you do and school teachers is that it's the most important work that can be done ever. Really educating our youth, putting your arms around the youth that we need to have so desperately in Chicago, get this leadership, it speaks for itself. My mother-in-law, it's just personal to me, she's 94 years old. She was a Chicago public school teacher in kindergarten her whole career and is still getting her pension and is allowed to live independently, without help from anybody. And that I take that very seriously. One of the things that you've been great with the acquisition of LCAM or BMO asset management before. And one of the things I know you've talked about and we've spoken about is how has it gone? And I know we'll get to this in the Q&A, but I wanted to have a couple of our members speak to this. And Jason, who helps me run this business, is my chief of staff. Jason, if you want to comment on our relationship.
The relationship with BMO, first of all, didn't start with the acquisition. We had them as a client before that. And so one of the initiatives that Jim put me on is to try to go down and visit the offices and focus on culture. Well, it was easy to do. I enjoyed going to Miami and sitting there and seeing the shared interests, shared values, the shared perspective on respect for the team. And so that was not a hard project, and I will offer myself anytime to go down to Miami with the team. So
appreciate that offer, thank you, Jason. And the market has spoken a lot to this combination of the success we've had year to date and what's in our pipeline, and our welcome from the consulting community has been unprecedented. I'd like to have Adam speak to that.
Great, thank you. And great to see so many familiar faces. And Jim is absolutely right. And as is Jason, the market has really embraced this transaction. We last year, our first full year together, we won 12 new mandates. This year, we've already funded $700 million, which raised us to our new high watermark since we've joined Loop at $9.3 billion. And to Jim's point, we've also earned 6 consultant ratings. And your consultant, Callan, has been including us in a search about every other month. So very exciting to build that rapport. And Loop has been every bit of the partner they've said and more.
Thank you. Thanks, Adam. I don't want to be remiss with the introductions. Adam Phillips, Scott Kimball, Jason Parks, and you'll hear more about everybody. So, Scott, I'd like to flip it over to you to also say a few things.
Thank you very much. So my name's Scott Kimball, Chief Investment Officer for Loop Capital Asset Management. I'll talk in the interest of time about what I think are our strongest differentiators and our value proposition for you as a fixed income manager. And a lot of it starts with what Jim had led off with, which is our institutional knowledge. We appreciate the opportunity to potentially join your lineup again. I've been with this team for going on 18 years, originally with its predecessor organization, Taplicana and Hayback. And I think our institutional knowledge of your plan, combined with what Loop already has a tremendous relationship with you, I think gives us a unique opportunity to partner with you. I talk about our core bond strategy as a whole. Philosophically, we look for yield enhancement and risk management in the context of high liquidity, quality, and defensiveness from an asset allocation perspective, meaning that downside protection. So when you rely on fixed income for diversification, we design our core plus strategy to focus on that and make sure that it's delivered for you in the context of all of those characteristics. I'll speak about our investment process concurrently. I'm happy to reference any slides during Q&A as needed, but I want to make sure I hit the main points of our investment differentiators. We believe in a relative value discipline. We marry top-down macro thinking on broad concepts such as interest rates and the economy with bottom-up security selection that's done by our analyst team. And our analyst team, I'm proud to say, are mostly individuals who we recruited as young individuals in their career and brought them in and taught them our investment process. And they provide us with what they believe are the most cheaply priced securities in their respective sectors. And we use the most cheaply priced securities to fill the parts of the US yield curve and the sectors, whether it's corporate, securitized, or treasuries, with the best ideas from our investment team. And they present that to us using a scoring process that's proprietary to us. We do believe and recognize the importance of broad measures such as credit ratings. But we also recognize that in order to add value for clients, we have to step outside and do some of our own bottom-up work. And we've identified an 11-point credit process that allows our analysts to give us a forward-looking view of credit, and it's allowed us to add significant value over time. But we always make sure to put that in the context of mandates. So in the case of core bond, we measure for a 40 to 60 basis point alpha target with about 100 to 120 basis point tracking error. And having that acute knowledge of the securities from the bottom up helps us manage those risks very acutely. That also just transcends credit, and it also aligns with what we do in structured product or mortgage-backed securities. There's a lot of information and a lot of talented individuals that provide us a lot of research in mortgage-backed securities. But when I look at our attribution and where we add value, it's been our bottom-up security selection in mortgage-backed securities, identifying opportunities, whether it's buying Ginnie Mae versus Fannie Mae or Freddie Mac, and where we buy the coupons, whether it's the current coupons, lower coupons from past interest rate cycles. We do a lot of that bottom-up work, and we focus also very much so on the collateral, and we'll identify what regions of the country or what characteristics we think are the most value add. And the last thing on the construction process I'll comment on is duration. Duration in fixed income is the factor that links all things. And in our core bonds, we keep a pretty tight band on duration. So typically plus or minus 10% of the benchmark is where we keep our duration. And we think that allows us to not only balance the risks of the portfolio, but also make sure that we keep the product, the strategy in balance for core bond. We think that duration timing can be very expensive. It's not something that we focus on. We spend more time on the yield curve construction. Are we going to own long treasuries versus shorter intermediate? But then also where we're seeing the most value on the bottom up side. When we put it all together, you'll see our portfolio's overall duration, though, does have a pretty narrow band versus the benchmark for broad risk management purposes. So I will pause there with 5 seconds left.
Thanks so much, Scott. Okay. I'm ready. We're ready.
I just wanted to give them an opportunity. If they want to do just a quick wrap up, if that makes you feel better, Jim, do a wrap up, that's fine.
I'll wrap up the plate where I started. I take a lot of personal pride, and you guys have heard me say this, born and raised and started my business here in Chicago and been the servant of Chicago. I'm involved in virtually every civic leadership area that impacts Black youth, particularly Black youth, around how we can increase education and opportunities, and very engaged with CPS as a firm, as a partner with you once again on the asset management side. We'll continue that, and we'll be a strong partner for you, not just shepherding your investments, but also in civic and leadership positions for sure. Thank you, Victor. I appreciate that.
Thank you. Some time ago, you started an internship program using CPS students. And I know that I've not seen you in quite a while. So can you bring an update on that program and how it has helped in terms of the students that have come in for interns through the years, and, some type of update?
Frankly, this is one of the things I'm most proud of. I've been on Wall Street now for 43 years. Mm-hmm. I started Loop Capital after 15 years. Loop is now 27 years old. I started an internship program in Loop's first year in business. You guys know Courtney Gibson that's been with me.
Of course.
Okay. Courtney was my first intern in 1998. She was 16 years old when she joined us. She was a sophomore in high school. Mm-hmm. She rose up to become president of the firm, is now one of the leading leaders on financial services at TIAA-CREF. Mm-hmm. Loop Capital Markets has probably put more Blacks on Wall Street than any other entity that's ever been. Mm-hmm. Our internship program this year had 8,500 applications for 30 spots. Mm-hmm. We particularly try to focus on youth from Chicago, diversified youth from Chicago. And we try to put them in these careers that, as you know, because you've seen how transformative opportunities are in financial
Mhm.
services. And you may also be aware, just from some of the people that sit in front of you and some of the folks that manage your money, you don't see a lot of African Americans in these
That's true.
positions.
Mhm.
Loop Capital Markets is the counter to that.
Mhm.
And we make sure that from the platform we have, we offer opportunities for the youth to really have these jobs and transform their lives, their families' lives. So the update on that is very, very, very strong. We've continued it. Our interns now that started with us 20-some years ago that were 14, 15, 16, now have leadership positions in big companies, Vanguard, PIMCO, Wells, T. Rowe Price, Fidelity, Goldman Sachs, Morgan Stanley, that are really, really leaders in their financial services. And when they see me on the street,
Yeah, I see.
the mothers or aunts see me on the street, they hug, they kiss, they thank me for taking their young people when they were 15, 16 years old and allowing them to have the life they have right now.
Thank you so much. And I was aware of this program in 2005 when I was here before. You know, I'd been back for a few
Oh,
years.
I know. I
But at
remember
any
you.
rate.
Yeah. Still look
But,
good. You still look good. I'm gonna tell
Well,
you.
I thank you for that.
Yes, thank you so very much. And thank you, gentlemen. I'd love to see a woman join you all the next time.
Okay.
Because I know you all have some phenomenal women leaders on your team.
Yeah. Tanya, just
Mhm.
GC is a woman. My head of HR is a woman. My Courtney was the one president's woman. She'll be replaced. Sydney Dillard runs
You
my
know, I
corporate
know all
finance.
of
You know
those
all this. So
people, right?
women
Okay.
actually, men
Right.
actually asked me at Luke, when are we going to get it?
Which is why I'm surprised you don't have Sydney or one of the others here. So I say that in earnestness, but also because we are on the record and it is an opportunity for us to be able to walk the walk and talk the
I
talk.
agree.
So it's important that we not only see them on paper, but see them present too. That's my first comment. My second comment is I'll turn everyone's attention very quickly because I have the unenviable role of being both a member of this board as well as the Chicago Board of Education. So oftentimes it is our desire and our goal for our values, our core values to be aligned, but from time to time, tactically and strategically, we may not always be aligned. And so in turning your attention to page 13, you list a very impressive list of representative clients and have highlighted for us in bold those which are local. And for that, I am very grateful. Can you speak a little bit to when the goals or sometimes the outcomes that are expected by some of the municipal funds may run counter to one another? How you kind of deal with that? So for instance, the Illinois Municipal Retirement Fund or the Retirement System of State of Illinois or SEIU compared to what our goals may be. And I know that's not necessarily about numbers, but it is about philosophy and approach to the work when you have these different clients that have to represent their interests. So how do you kind of make all that run together when it may seem like in the court of public opinion that there are warring factions? Did I put that delicately?
Yes.
Okay.
You know, when you hire us to manage your money and to make sure that the hardworking school teachers that don't get paid a lot of money have a pension there for them for as long as they live, that's what we focus on. I think that's critical. When I think of school teachers, first and foremost, I think they're underpaid. But I know we've got a significant constraints here and you can't get paid what's not there. But what we can do is make sure we maximize those opportunities that they have for the years that they have after their retirement. They can live independently and prosper. And now I know there's issues, particularly I know there's issues with the board and the city and all of that stuff that may come into play with the other side of our business. But for this side of our business, we're focused on making sure that the teachers have a pension there for them as long as they live.
Thank you, Jim.
Any other? Oh, yes, trustee.
Along that line, and Mr. Reynolds, we met many, many years.
Oh, I remember you, Maria.
Thank you. Everyone does.
I know.
Yes, when you guys were first coming into business and changing all that, you recall that, President? Okay.
Yep.
Page 6, your EEOC. And to kind of piggyback on what Trustee Wood said, and I'm looking at your numbers also for Hispanic, male, and female. males, 21%. You have 3 traders, you have 3 male employees in compliance. But females, we've got 2 professional sales, marketing, and 1 administrative support, office clerical. What can you tell us about that? Or
I'm going to let, Scott manages that office for us and really manages the personnel. Scott, you want to speak to that?
Yeah, so our overriding philosophy in talent recruitment has always been searching for people who have the right attitude, the right aptitude, and the right work ethic, but need an opportunity. And I think that we're always acutely aware of both making sure that our constituents see a team that's diverse where they're represented, but also that our team represents the greater Miami area where our firm is located. We have partnerships with Florida National University, Florida State University. This year, we had an internship opportunity for a young Hispanic female who is going to be a rising senior. So we keep ourselves abreast of what our team looks like, but also making sure that we're giving equal opportunity, primarily in partnership with the Loop internship program. There is always going to be a place for opportunities to arise. For instance, our firm's founder, originally Terry Alvarez Canada, has ingrained in us that the importance of that. So we are always going to be at the forefront of making sure that opportunity is shared equally. And as people train and elevate up the org chart, you'll see them rise into leadership positions.
right, because on your report on page 7, firm year over year, you did have more female Hispanics on your staff, 17%, 5 and 5 people. So it seems like the numbers are dropping. Is there a reason for that?
I don't believe there's anything I would attribute to a standout reason within that community. We do have some turnover at times. People make family decisions or they leave the area, but we always address that in our recruitment process as far as making sure that we get back on track.
Okay, thank you.
And Maria, I'll just quickly say diversity is a hallmark of what we do. I've not been of a mind, and I think it permeates the street, that you have to compromise performance for diversity. And I know that's becoming a major thing now as folks
And
start
that's so fair.
backing away from ESG, but you'll continue to be proud of us as a partner and how we do those things as time goes forward.
Thank you.
I'm glad you said diversity is in your mind. So your outreach program for Chicago Public School students,
Paula, can you speak up a little bit?
50% of our, or was it
Speak up a
somebody?
little bit.
Okay.
Yeah,
Or just pull your microphone closer.
I know because of this. Sorry. So I'm glad diversity is on your mind, and your outreach program for Chicago Public School students that you talked about, 50% of Chicago Public School students are Latino. So would you be considered maybe broadening that program to include also Latino students as well?
So our program already does include Latino students, and it will continue to include Latino students. As this population has continued to grow, we're going to be responsive to the city and our client base, and particularly me. I mean, this was kind of how I was raised, and it was when you were in Inglewood.
Thank you for clarifying that. I just wanted to make sure because you only mentioned African-American
100%,
students. So.
100%.
One final question. I just want to, I know we are in business with you. Can you tell us what is your edge over the peers as far as your process, over your peers, as far as your process and your track record? Quickly, if we could just give us an answer to that.
We really, Loop doesn't enter this with you fit our model or it doesn't work. Our model is really responsive around what our clients' needs are. I think the thing that makes CPS just such an amazing partner to the firm, and it's been that way since our inception, is our interests are very squarely aligned. I came from the CPS system. I was educated by the CPS system. I'm committed to employing these youth to do this sort of major work. We're together on that. I'm also committed to making sure I'm an advocate for the important things for the teachers, because I believe in that, and it's been a part of my family. And so I don't think you're going to have any manager sit in front of you and say the things that I could say. They just don't, one, they don't believe it, they don't do it, and they're not really a part of this city. It's very difficult to come into the city of Chicago from somebody that's not been from here and understand what we do here and what's important to us here. It's just difficult. So,
Thank you so much. That concludes our time. We are so happy that you were able to come out. We appreciate it. Thank you. Thank you.
well, it was a long trip for us.
Just come on down
Come on
upstairs.
down. Thank you all.
Jackie,
right.
did you
All right.
see I had my hand up?
Oh, I'm sorry. Please, one moment.
Oh, yes, yes.
I'm sorry. I did not see that.
Sharon Riley, she's,
Okay.
Oh,
Virtual.
okay.
Mary, go right ahead.
Yeah, well, I guess we've known each other a very long time.
I would say that's correct. Yeah.
What happened to Al Grace?
Oh, Al, you always like Al. And you really, Al, I don't know how he trumps me all the time in your mind.
No, but I mean, he was the one that approached us way back.
Yeah, Al retired about 5 years ago.
Oh, really? Well deserved,
yeah,
I'm sure.
No, his investment in the firm had done well. As you know, he started the firm with me on day one.
Right,
We're
that's what I'm
27.
referring back to.
Oh, yeah. And he did a great job of building the firm. As you might remember, he was Mr. Inside, I was Mr. Outside, and the
Right.
team worked well. I think he was approaching 67, 66, and he just came to me and said, Jim, I don't want to do the travel anymore. I'm ready to enjoy life. He got remarried and bought a house in Michigan. So he's enjoying his retirement right now. We still communicate, though. I'll tell him you asked about him. I'll tell him you did ask about him again.
Yeah, because I think he was the first contact we had.
He was. He was. Yeah.
Thank you.
Thank you all so much.
You're welcome.
Thank you, Mary. Thank you all so
Thank
much
you.
again. And good morning and welcome.
Morning.
Our next presenters are Longfellow.
Okay. 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 All right, so we have adjusted the schedule just a tad bit. We want to give you opportunity to give the highlights of your presentation. So we're going to have 10 minutes for the highlights. Then we will have 10 minutes for questions. We want to extend the time for questions so that we could give the trustees every opportunity to ask you questions. I am Jacqueline Price Ward, and I am Chair of Investments Committee and Vice President of this board, and we are so happy to have you here. So at this time, you may begin.
Thank you for having us. We can turn to slide 4 for overview.
Do you mind turning your microphone on?
Yeah.
Thank you.
Sorry about that. If we could turn to slide 4, please. Thank you for the opportunity to be here this morning and to present our capabilities in managing our fixed income core strategy. My name is Corinne Larson. I joined the firm in 2013. I lead the marketing and client service team, and I'm a relationship manager at the firm. With me is Akshay Anand. He joined the firm in 2008, and he's the lead portfolio manager for our core strategies. So if we could advance to slide 4, please. It's an honor and privilege for us to be here this morning. Many of us at Longfellow have teachers in our family, and we value and respect what you do. In the interest of time, I'll provide a brief firm overview, and then Akshay will describe our investment philosophy and process. Longfellow is based in Boston. We were established in 1986. Today, we manage over $18 billion in assets for institutional investors across the country and also here in Illinois. Longfellow is 100% employee-owned, and this is important because it means that our interests are aligned with our clients' interests. One of the things that makes Longfellow unique is that we have long-term continuity and succession plans in place to ensure a smooth transition to the next generation. And we know that our plans work because our original founders have since retired. In 2010, we became a certified business women's enterprise, and today we're 77% women-owned. We take a customized approach to managing our clients' assets. All of our accounts are separately managed and can be customized to meet any investment guideline needs, whether it's liquidity, credit quality constraints, or anything else that you might like. Our goal is to produce attractive risk-adjusted returns over a market cycle and to provide excellent client service. We focus on developing relationships with our clients and their consultants. You'll have direct access to the portfolio managers and to the entire investment team, as well as the client service team. Akshay will be your primary portfolio manager contact. He's backed up by David Horsfall, who's another experienced portfolio manager. I will be your primary relationship manager, and I'm backed up by Kevin Chisholm and Nicole Burbridge, who are also experienced relationship managers, as well as the entire client service team, who provides standard and customized reporting based on your needs. Our goal is to be a resource to you. We're proud to say that we've never lost a client due to an investment performance or a client service issue. In fact, we still retain our first 2 institutional clients after more than 35 years. We have experience working with public funds. We meet with many of our clients and their consultants regularly. We produce monthly and quarterly newsletters, publish client communications and white papers on timely topics, and we can provide training on investment topics. At the bottom right hand of the slide, you'll see that we've won awards across all of our strategies, including the PSN Top Guns Manager of the Decade Award for our core strategies numerous times. And Akshay will describe how we do that. So I'll turn it over to you.
Thank you. Good morning. I think we're sort of constrained on time here, so I realized that I should probably address the one thing that would be helpful to you folks to meet your mandate here, which is to pick the right manager, and that is, how are we different? How do we differentiate ourselves from our peers, and maybe touch on a few facets about our philosophy and portfolio strategy along the way, if that sounds okay. So, when we think about how are we different, we generally, think about the competitors or the peers that we go up against in 2 different groups. One is the larger managers. It's a little bit more straightforward comparison when we compare ourselves to some of the larger managers. The big problem that some of the larger managers face is that because of their size, they can't participate in every part of the bond market. And that's where we sort of specialize. It's unfortunate. It's because they just don't have enough to move the needle, ultimately, because some of those parts of the bond market are really small. And so what happens is they're forced to invest in some of the larger sectors like treasuries, corporate bonds, to a certain extent, mortgages. And they're also forced to use derivatives. They're also forced to make duration bets. And that what that ultimately leads to is their risk reward profile ends up looking very different from what a smaller boutique manager like ourselves would have, which is why we always tell our prospective clients that we are very complementary. So like you have an existing bench of managers that are fairly large. We're very complementary to them because our risk reward profile looks very different. Now, when we compare ourselves to some of the smaller boutique managers, it's a bit more nuanced, but we are different. There are differences in strategies, especially if we're comparing ourselves to small managers that have a similar approach to ours. You'll hear things like bottom-up security selection, portfolio constructions, being value-oriented or operating in a relative value framework where we decide what we're going to buy based on valuations, relative valuations across different sectors. So that's where we're similar, but we're different, and I'll explain how we're different. And there's a few things about our philosophy. There are a few things about our portfolio strategy that makes us different. I'll start with the more philosophical part. So it all sort of starts with this simple recognition that when our clients, the asset allocators, think about their bond allocation, that's their anchor to windward. They have equities, they have private placements, they have real estate. They have all these other sectors that they use to improve the return profile. When they look at their bond allocation, their fixed income allocation, they're looking for a hedge. They're looking for stability. They're looking for, at the right time, liquidity. And so that recognition is very important to us, even though it sounds sort of cliche. We make sure that that's part of our DNA. The second thing that you have to take into mind from a philosophical standpoint that, or a recognition of sorts is, when it comes to bonds, your returns are asymmetric. In other words, on any good day, you get your principal back and a little bit of interest, but on a bad day, you can lose all your principal, which is a nuance in the bond market. So when you think about, risk, particularly when you're managing a bond portfolio, you have to have a defensive approach. And I think that's the underlying philosophy. We will always, whether it's our philosophy, how we manage our portfolios, we will always compare as the more defensive manager. And that's been part of our DNA for a very long time, and we continue to do that. What does that mean when you look at numbers? How does that sort of show up? One of the areas where that's going to show up is when we talk about our objectives for returns. We tell people that, and like other managers do, other boutique managers do, that we're trying to target a certain number of outperformance versus the benchmark. You will see that our objective or our goal is slightly lower because we put so much emphasis on how we get there. And it has to be based on efficient risk-taking. One of the things that we focus on when we talk about numbers and how to sort of know that we're doing that is that you'll always find our standard deviation to be below benchmark, definitely lower than our peers, and standard deviation of returns. There is I believe, slide 11, if we can move to that, shows that. Yeah, you skipped it. I'm sorry. Maybe I was wrong. One slide back. That one. So you see that chart on the right side. It's a very straightforward chart. On the horizontal axis, you have standard deviation, and on the think risk, and on the vertical axis, you have returns, think reward. We basically drop the diamond that you see is the index in the middle that breaks that chart area into 4 different quadrants. We're focused on that top left quadrant, which basically says low risk, high reward. That's where we want to be. Now, when you compare us to our peers, you will notice that there are some who take more standard deviation risk, but have higher reward. So that's the philosophical difference. We want to be on the top left. I'm not saying what they're doing is good or bad. Beauty lies in the eyes of the beholder, but that's who we are, how we differentiate ourselves. It's not that important for us from a whole return perspective to be in the top decile, as long as we're in the top quartile when compared to our peers, because we take an equal amount of emphasis on how we get there, the risk profile of the portfolio. Now, if you switch to the next slide from a portfolio strategy standpoint, I'll point out a few things that also show that we're defensive. If you look at the chart on the right, one of the things that we do is we invest in all different fixed income asset classes. Now, there are some small boutique managers that focus more on corporates. They might focus more on securitized. We do it across the board. And what this chart is really telling you is a range of where we invest, which is the blue line, how low it has been, how high it has been, the watermarks. You will notice if you compare ourselves to sort of a peer, their high watermarks or their high points will be higher than ours. I'll stop there and see if there's any questions.
Okay. All right. Any questions? Yes.
I think if you want to just summarize to finish up, that'd be great.
Do you want to do the?
Well, I think he wants you to finish.
Oh.
What you're saying.
Oh, so that was my last really sentence that I was just trying to say that our approach, if you add up all,
Be on time.
yeah, the defensive nature of our strategy shows up both from a philosophical standpoint and strategy. The one thing that I will add is that, over a 5-year, 10-year period, we don't shy away from telling prospective clients, if you want to challenge us on numbers, because there are a lot of managers who say, hey, we're trying to provide you with risk-adjusted returns. But what does that mean? We mean it by saying below standard deviation, below benchmark standard deviation, and on a 5-year and a 10-year cycle, our information ratio will be in the top quartile.
Thank you.
Any other questions? Yes. Trustee Woods, then followed by Trustee
Okay.
Rodriguez.
Thank you so very much. And thank you for your presentation and for being so timely. That was great. I am taking a look at what is my page 10. I'll draw everybody else's attention to whatever the pages that has I'll call it the lookbook of team members on. And I appreciate you providing the photographs along with the names. And I'm going to call out why I appreciate it. And maybe that echoes that of my colleagues who sit with me. But oftentimes, we certainly live in a moment where we are trying to be as transparent as possible, because we know historically there have been companies that have not been transparent and will put names that don't necessarily match the lived experiences of the names that go along with those. So I do appreciate those pictures. It also allows us to think more deeply when we talk about those individuals who have historically been left behind. So to have a more thoughtful conversation that goes beyond just race and ethnicity and nationality, but talks about, folks who have been in this country for generations and have historically been farthest away from opportunity. So that's where I will root my comment and my observations. So as I look at the photographs, there are certainly some faces that I would, like to see more of. Certainly more Black faces, more Black males. Those are the kinds of folks that I know have been farthest from opportunity. We now live in a state where there is legislation to try to encourage corporations to diversify their boards and their decision makers. Can you talk to me a little bit and to my colleagues about, when I look at this photograph or this lookbook, what am I seeing now, and what will I be able to see maybe in the future, a year from now or 5 years from now, with the anticipation that there will be more faces that look like mine?
Sure, I'll take that.
Thank you.
So diversity has always been important at Longfellow, even before it was a headline. We've been a certified women's business enterprise since 2010. And we're always working on diversity. It's important to us. And we know that there are areas we can improve in. So to your comment about, other faces, we have an IDEA committee that's inclusion, diversity, equity, and access. That's very active. As a firm, our community is important to us. Last year, we partnered with the Black Economic Council of Massachusetts. And what we're doing is we're working with them to help diverse-owned businesses, where we're providing not just a cash contribution, but our expertise and our time. And so we're working with Roski Rides right now out of Worcester, Massachusetts. It's a Latina-owned firm that provides transportation to students between schools or for extracurricular activities. And they've just won a large grant from the state of Massachusetts, and we're helping them with financial planning and budgeting, as well as with some of their proposal writing and things like that. And with BECMA, we're also working on identifying the next organization that will help. And it helps them. It also helps our staff to build their skills and their confidence in what they can offer. Also, we're involved with our area colleges in Massachusetts, in Boston especially. We have a lot of colleges and universities where we work with other businesses, helping to place underrepresented students in internships. So we know that it's important. It's important to start at the bottom up. People like myself, I'm from Elkhart, Indiana. I didn't know anybody in the investment management industry, but I was able to work my way into it. We also are starting to work from the top down. So you'll see that Nicole Obi is on our advisory board. She's a very influential woman in Boston. We're honored and thrilled to have her on our board, but we also know that she has a network that we can tap into. So this is something that we take seriously and that we work very hard to work on. And there are some other faces that aren't on this page, but we agree we need more, and we're working on that.
I do appreciate your thoughtful
I just
answer.
make one more comment real quick,
Yeah,
if you
sure.
don't mind. So I have been working with, I'm not sure people are familiar, but the CFA Society of Boston is one of the largest investment professional organizations in the country, partners with all the similar organizations across the country. And they set up a strategic committee for diversity. And I've been part of that for the last few years. And we've done a lot of analysis, and there's a lot of ways, things can do to make their workforce diverse. But our analysis, our work showed that it's not a Longfellow problem. It's not a industry problem. It's a community problem. It's a Boston problem. It's a Massachusetts problem. And the biggest problem that we just realized was that, particularly in the Boston area, we lose kids right out of high school because what happens is their graduation rates are really high, but we keep losing them. And the reason for that is because there's no promotion of how success is changing, because there's an image that for certain people from minority groups, there is no success. There has been. So we're doing our part to change that in the community and promoting that. And then Barbara and people like, I work with the Wiley Network that basically provides financial literacy for first generation students whose parents are from socioeconomic backgrounds that they just don't have the tools to educate them on things like what are the best practices for maintaining a 750 and above FICO. So there are a lot of things that you do have to do at the community level, which will probably not help us in the next 3-4 years in making our workforce more diverse, but the next generation will hopefully not have that same problem.
I do appreciate that answer. I would like to challenge you to think more deeply about that. MWBE programs have been around since the 70s and 80s. So congratulations on being, that designation in 2010, but certainly we can think more deeply and go beyond that. And I do appreciate your work with the youth because that's how we build our pipelines. But I hope that the next time we see you, we don't have to wait another generation to see that diversity in your corporation. Thank you.
Thank you. Trustee Rodriguez.
Yeah. And as a trustee, and to be fair, we want diversity amongst the whole group. It's not just one minority over the other. But according to your EEOC reports on page on 5 and 6, the handout they just gave us a little while ago, on 5 and 6, since 2020 until, now 2024, so 3.5 years, what I see here for male EOC, male 0%, female 1%, and that's up to December 31st, 2023, and we're 6 months later. That's all we see. The only Hispanic we see is one female who's in sales.
She's a relationship management associate.
Pardon?
She's a relationship management associate. She works
Correct.
on my
yes.
team.
So you have one person. So
Yeah.
we're going 3.5 years since the start of your report.
Well, so this shows what we have at the end of the year, but there was turnover during the pandemic and the numbers are fluid. As I said, we do try to be diverse, and we've had others that have come and gone. So especially during 2020, it was difficult to retain people because they weren't in the office. We were all remote. So there's some numbers you just don't see because they weren't here at the end of the year. But every hiring manager has an annual performance goal to have a diverse slate of candidates when we have open positions, and we're measured on that. So we really do take it very seriously. And please keep in mind, we're only 57 people. We're a small firm. So we have one Latina, we have one African-American woman in our compliance department that you don't see their pictures, but we are conscious of this and we work on it very hard. We also have interns, and we have Northeastern University has a co-op program. So they come and work with us for 6 months at a time. And because they're not full-time employees, they don't show up in these reports. So a lot of our diverse people that we train to work in the industry are coming through these programs.
Do you do anything like exit interviews to find out exactly why people are leaving? Because that might be something you want to look at and see if there's room for improvement or what specifically it might be.
We do. And one of the issues that we have is we hire diverse candidates, we train them, and then they get recruited away to larger firms that pay more and have better titles. So that's been an issue.
But you keep 55 other people, so there must be, right? So 55 stay out of 57, let's just throw that out. So there's something that's happening in one area and maybe not the other. Thank you.
Thank you. Trustee Choa.
Thank you for all the responses. I know sometimes it feels like we're grilling you, but we do it to everybody. And it's something we really believe in. So I wanted to ask Kay, I think you were talking about the way you could be utilized because of the way you made up your groupings, that you could, if I understood you right, you said that if you're not chosen outright, you could see a strategy where you are chosen alongside a similar group, and then we'll put you in that part of our portfolio. Did I understand that right?
Yeah, so comparing ourselves to your existing managers, which are the larger managers, we are complementary. because the risk reward profile that they have is very complementary with the risk reward profile, because think about their portfolios, they'll be invested in a lot of different ways, they'll do derivatives, they'll do other things, which we don't. We're all dollar-based cash bonds, no derivatives. And so it's complementary with their strategy, the larger managers.
Okay, thank you.
I'm sorry. So in terms of an investment strategy, I was just curious, how does geopolitics play into it? Because I'm noticing that your seems like your treasury, you're increasing those investments, but I understood that geopolitically that some of those investments are being lower. So how do you?
Some of those investments, I'm sorry, what?
The strategy, how do you use, I guess, geopolitics in
Yes.
determining your allocations?
So yeah, we build our portfolios from a bottom-up perspective, but we do have a macro top-down view. So geopolitics is global or US is part of that. And so how we think about it is the same way we think about really anything else. How does it impact a particular industry, a particular issuer? There's obviously a certain degree of forecasting, especially when you're thinking about politics and talking about elections, and we have to take that into account. The one thing that we've always found, and part of the reason our treasury allocation has been going up, that it does bring a certain level of uncertainty. So just because you have uncertainty, that means more volatility, and we want to make sure that our portfolios are protected from the volatility. That's something that we take a lot of care in. That's one of our unique things, that we want to have a stable, consistent profile, no sawtooth returns. So that's why we've been increasing the treasury allocation. And that's what I meant when I said, you will always find us on more on the defensive side. So if you look at the years that we've underperformed because we were too defensive, not because we took too much risk and something blew up and now all of a sudden we're in losses. It's because we didn't have enough risk, we were defensive, and risk did really well.
Seeing no more questions, thank you so much for coming out.
Thank you very much.
Thank you. And we appreciate you being here.
Thank you.
And that concludes our time for this presentation.
Thank you for the opportunity. We appreciate it.
Yes, you are quite welcome.
Thank you again.
Oh, no.
Good morning.
Our next presenter is Merganser.
So, this presentation, I just want to give you the guidelines for this presentation. We will have 10 minutes for presentation, so you can get your most important points out. And then we will have additional 10 minutes for questions that we want the trustees to have the opportunity to ask you what questions about your presentation. So the presentation.
Great. Well, thank you very much. We're pleased to be here. My name is Allie Morse, and I'm a relationship manager here at Merganser. I have been here at Merganser for about 3 years and spent the bulk of my career within the fixed income space, both at larger firms and a smaller shop as well. With me here today, I have Andy Smock. Andy is our co-chief investment officer and portfolio manager for our core aggregate strategy, which we'll be discussing here. Andy's been with the firm for 20 years and has been a portfolio manager for our core strategy for over 15 years. If we move ahead to slide 3, this is where we have provided a brief firm and fund strategy, and we'll do our best to highlight a lot of this in the next 10 minutes. But at a high level, our core aggregate strategy seeks to generate excess returns of 80 to 100 basis point gross of fee through a market cycle. But we've also proposed a discounted fee for the plan of roughly 15 to 16 basis points, which we really believe presents an attractive offering for the plan that can really help achieve your investment goals and top decile return objectives as well. and we hope demonstrates our excitement to work with the plan. The following few slides, we've included a diversity profile. And, as a small firm of about 32 people, we are proud of some of the efforts that we've made over the past few years. Over the past about 4 years, we have had 8 hires total at the firm, all of which have been diverse hires. But we also recognize we have a lot of work to do. And as a firm, we are committed to creating a culture of a more diverse, equitable, and inclusive company. If we move ahead to slide 6, I can really introduce you a bit more to who we are as a firm. So Merganser is based in Boston, and we have been focused exclusively on investment grade fixed income since the founding of the firm over 38 years ago. Today, we manage about $17 billion in assets, and we very much identify as a boutique investment manager. So where we're looking to take advantage of our size and the investment process and really be nimble in our approach. We partner with a wide range of institutional clients, which you can see on the right-hand side. The public funds represent our third largest client type of about 13% of our assets, a little over $2 billion across 7 clients. And it's really been a growing segment for the firm. It's also one of our oldest client types, so dates back to 1995, so nearly 3 decades of experience working with public clients. With fixed income being all that we do, we are really dedicated to this asset class and focus on doing what we do best, which we believe comes through with our strong total and risk-adjusted returns. If we move ahead to slide 8, I can talk a little bit more about the $17 billion that we manage. And like I just mentioned, we manage investment-grade fixed income strategies across the curve. Our core aggregate strategy is by far the firm's fastest growing strategy at the firm. It is about $4 billion in assets and has a phenomenal top quartile 28-year track record. The vast majority of this growth really has come through both the consultant and the public channels where I believe that these firms have recognized our strategy as a differentiated offering in this space. Before passing it to Andy, we can talk a little bit about the team, which you can see on slide 9. And on this page, we've included all members of the investment team and key members across our operations and compliance team. We have a very experienced and stable investment team where portfolio managers average over 27 years of experience and 22 years of tenure at Merganser, and our analysts average over 14 years of experience. Our core strategy has 2 portfolio managers, which is Andy, alongside Todd Copenhaver, who's our other co-chief investment officer and portfolio managers. Additionally, all clients have a dedicated relationship manager, which would be myself for the plan. And you're further supported by a team of 7 for any and all of your reporting needs and consultant needs as well. But it's really normal for us to have, our co-CIO here. And we believe that while you have access to me at all times, 24/7, that direct access to the investment team really allows for us to develop those strong thought partnerships with our clients, which we believe leads to long-standing client relationships and best results for all. Yeah.
Thank you.
Now, Andy, thanks.
Well, thank you for having us in. Really here. Carving out a little time for us. I do love talking about fixed income, so I'm going to keep myself to the time with my stopwatch. But I want to give you a little bit of a sense of Merganser, our style, particularly because you're meeting a number of managers. I'll try to focus on differentiators and not repeat ourselves as much as we can do. We consider ourselves traditional fixed income managers, so no derivatives. It's all dollar denominated. We don't make any duration bets, so it's really the kind of classic fixed income of buying bonds that mature at par and reinvesting those cash flows. We also, especially in the core space, when we're buying a lot of 10 and 30-year bonds, we do often sell before they reach maturity. We underwrite the bonds to maturity to make sure we're making good credit calls. But over that time frame, valuations change and our thesis changes. So another part of our strategy that's very prominent is sector rotation. So we are very fundamental, getting the credit calls right, and then we rotate through sectors as valuations and the economy changes. On page 11, there's a lot about our investment process. And I think the important thing to differentiate Merganser here is that we really designed our team to maximize communication. Now, investing is a very communicative, organic, human process where we need to understand each other's ideas, and we really manage by team. It's not a star portfolio manager system that's setting all of the targets. So as a core PM, my job is not to tell people what to buy. It's really to encourage thoughtful debate and to make sure that I hear everybody's voices and that we all agree with the end output. In fixed income, it's investment grade, it's very high quality, and there are a lot of bonds out there. So in reality, at Merganser, everybody on the team has a veto. If someone doesn't want to buy something or they don't think we should for any reason, we move on to something else. There's just a tremendous number, thousands of different CUSIPs and bonds that we can purchase. So that culture at Merganser of everybody having a veto really emboldens every member to speak up, and it's a big part of their job. Additionally, we're all compensated exactly the same way. It's on the performance of all of our products and how we're serving our clients. We don't want little fiefdoms of someone who's a better marketer pitching to a PM about invest in my sector. It's all equal. So not investing in your sector is just as important as investing in it at the right times. And I would say the last point I want to make on page 11 is just that the stability of the team is very important to us. That because investing is such a interactive business and the track record is based on decisions by those individuals, we want to do everything we can to promote and encourage team stability, which we're very proud of. Our core product on page 12 does seek to be 80 to 100 basis points over the benchmark, which we have successfully done over many market cycles. I'll talk about performance year to year in just a moment. One of the primary ways we achieve those goals is by having wide sector bands. So you can see on page 12 in the lower right, there is a wide band within which we participate in these sectors, and that is to add risk, but also to de-risk. There are times in the market we want to own safer securities, government guaranteed treasuries or mortgages. And there are times when we think you're getting paid very well to add. On page 13, you get a snapshot of what we look like today. There's a lot of information on this page. I'll pick apart a few pieces of information to focus the conversation. The duration is very close to that of the benchmark. Right now, our average quality is close to the benchmark. In the upper right, you'll see the maroon bar is what we looked like last year. The blue bar is this year, and the gray bar is the benchmark. It was an interesting 12 months. There's a lot of opportunity to move around, and we did so. We achieve our total returns not just by taking more risk, but by rotating. And that's what we consider the real value add of active management. You need to pick the right bonds. You can't have any defaults in your portfolio, but beyond that, you need to own securities that you're getting compensated for the risk. In this market, we do think things are very expensive, so we have de-risked the portfolio meaningfully. Decreasing credit, adding to treasuries, adding to agency mortgages, continuing to hold government guaranteed commercial mortgages, which are mostly multifamily housing backed by Fannie and Freddie. On page 14 is our performance. And you can see over cumulative periods, we reach our goals of 80 to 100 gross of fees. But more important, I think, is page 15. And it's really important to Merganser that we have very predictable returns. And predictable doesn't mean guaranteed. It just means that in volatile markets, we're going to do well. And in weaker markets, we're going to be more benchmark-like. The risk-adjusted returns are most important to us. And you can see that on page 16, we are top quartile total returns and risk-adjusted returns, which is measured here by the Sharpe ratio.
And to just really briefly conclude, on slide 17, again, we've included our fee proposal, which we've actually reduced since originally submitting our RFP. And again, I hope that illustrates our excitement to work with the board and hopefully just conclude with much of what you've heard from the last 10 minutes on us on why partner with Merganser. Fixed income, investment grade fixed income is all that we do. We're dedicated to this asset class. We have a very experienced and stable team, and we believe that having direct access to the team really allows for those deep thought partnerships with our clients. We're a boutique manager looking to take advantage of those inefficiencies, and we offer only custom SMAs. So really working closely with our clients on your unique needs. I want to thank you again for your time. I really hope that we could work together.
I will get to the question period. Thank you.
Hi, thank you for your presentation. And as one of my fellow trustees pointed out, sometimes it feels like an attack from us, but I think personal, it's not an attack. You said you're committed to expanding diversity because your current profile doesn't bode well for people of color, just nor does your historical data. So help me understand, what does that mean, committed to expanding diversity?
Yeah, sure. So for Merganser, we have a D&I committee. I'm actually chair of that committee, along with 7 other members of the firm across all business lines and senior management. And so we're really focused on the efforts that we're doing and reevaluating some of the ways that we've thought about diversity, equity, inclusion. And from a hiring standpoint, as a small firm, we don't have this regular need for hiring, but we've been really thoughtful about thinking and restructuring some of those practices and really thinking about the pipeline and trying to improve that and focus on key partnerships that can help us, quite frankly. And so one partnership that we're really proud of is with the United Negro College Fund, or UNCF, and their Lighted Pathways program, which is a newer program that focuses on getting more Black talent into not only the asset management industry, but specifically Boston. And so we hosted our first intern this summer, and he's from Atlanta, Georgia, and actually goes to University of Chicago here. And that's an example of something we're really excited about with our continued partnership. And as we continue to improve diversity, which I agree we have work to do, we're really focused on the culture and making sure that all members of the team feel really included and it's equitable. And some programs that we put in place are a mentorship program for some of those more junior members, as well as a woman employee resource group, which is that's been great in order to, with people that have had young kids and some of the improvement on our family policies. And I think that we know we have work to do, and I know that we might not have the ownership profile that is what, Chicago Teachers is looking for with a lot of the diverse managers, but I do feel like we have been committed to improving our overall diversity profile.
Thank you.
You're welcome. You know what? I just key into little buzzwords that I hear. And so I just want a little clarity here.
Sure.
I heard words like you're dealing with bonds and securities and the variables, and that you reinvest. And I'm just listening to little things. And I'm thinking, were you doing hedge funds also at one point, or is someone on your staff kind of from the hedge fund idea?
Yeah, so it's a question.
Like if there's any hedge fund, yeah.
Yeah, so there is nothing related to hedge funds in anything that we do.
Okay.
So in that, there's no leverage.
Mm-hmm.
There's no long short of anything.
Mm-hmm.
It's really very simply buying bonds, like a 10-year maturity bond,
Mhm.
watching it come close to maturity. And if we like it that whole time, we keep it, and matures and we do it again.
Okay,
We
but see,
don't-
you never mentioned the fact of maturity.
Yeah.
Yeah.
Thank you. And I can see your point that we
Mhm.
do hold many bonds to maturity, but not all. Over 10
Mhm.
years, things can change. and either our thesis on the credit changes. You know, I use the example of we owned Carnival Cruise Lines when COVID hit.
Okay.
We're like, oh, I'm not sure I want to own a cruise ship company during COVID. So we sold that and we bought something else. So we have the sell discipline on the credit side that we might sell before maturity, or something just gets too expensive. You know, you buy JP Morgan and it just, from last year, you liked it. This year, you don't like it anymore because it's too expensive. And so there are multiple reasons why we sell, but we always think about it as holding to maturity, and probably about half the portfolio is held to maturity.
Oh, okay. Well, I just needed clarity there. Okay, thank you.
Trustee Ochoa?
So we know that 2022 is hard period for everybody. In your core aggregate composite, and it underperformed the index, is there anything that you've changed to better, perform in the future through such things like that, the weird year that's 22?
Yeah. So the short answer is not really. We really actually are comfortable with the profile of returns that we have in 22. That was a risk-off year. Interest rates were going up. We don't time interest rates, so we're not going to change that. It's a very difficult thing to do, and it's easy to get very wrong. And all bonds that you own that have spread to treasuries or more risk than treasuries underperformed, just like equities underperformed. So unless you owned mostly treasuries and you could predict what happened in 2022, we couldn't have done much better. So being benchmark alike in a really risk-off world actually feels okay to us, so that we can then do really well when things are volatile and there's opportunity. So if you look at, if we go back to page 15, those annual returns that you're referring to, 2020, we did really well. That was the COVID pandemic. 2023, we did very well. That was the banking crisis last year. In 2022, we were kind of benchmark alike. And 2018 was a very kind of boring year. It was very benchmark alike. So I don't think I would change anything. We like being benchmark alike when there aren't a lot of opportunities, and we like really beating the benchmark when there are.
Thank you.
See any more questions? I'm seeing none. So then I guess we can conclude this session. Thank you so much for coming in and sharing your strategies with us. And that concludes the presentation and question period for this time.
Great. Thank you again.
All right.
Good morning. Good morning. How are you? Good. You want to start here? Yes, absolutely. All right.
Our final presenter is the AFL-CIO, Housing Investment Trust Fund.
Thank you for being here. Our presentation will be 10 minutes. So we want you to have an opportunity to highlight everything you want to highlight, but we want to leave a little bit more time for questions as we haven't had a lot of questions. So, and your time.
All right. Well, thank you for the opportunity to present the AFL-CIO Housing Investment Trust. My name is Leslie White. I'm the Chief Marketing Officer for the organization. I manage our marketing and investor relations function. With me is Chang Sa. Chang is the CEO and CIO for our organization. We've been working together over 20 years. So he's my brother as well in labor. First of all, it's an honor to present. My mother was a teacher. She supported my dreams of graduating from Howard University undergrad and Howard University Law School and practicing law. But I started my institutional investment career in Chicago, actually, and have been here at the AFL-CIO Housing Investment Trust since late 1999 and been committed to the great work that we've been doing specializing in fixed income investments in affordable and workforce housing. The Housing Investment Trust, as you can see on page 3, is a $6.6 billion high credit quality fixed income SEC regulated fund. The mission of HIT was created through discussions with AFL-CIO and Dr. Martin Luther King back in the 60s to address the affordable housing crisis, which is still a crisis today. Today, we have 366 institutional investors, including public funds as well as union funds, including the New York City Teachers has been one of our major investors since 2002. We have 31 investors, institutional investors in the state of Illinois. Pages 7 and 8 provide a snapshot of the HIT as well as the breakdown of our investors. On page 10, we have a long history of impact investing in the core fixed income space, investing in over 600 projects, including 67 in Chicago area. And we want to, do a lot more here. We have a strong commitment to impacting the affordable housing crisis in Chicago and would like your investment support. We are asking for your investment support first because it's a good investment fund. It's a very strong high credit investment fund. But second, because it supports the collateral benefits for investing in housing for working men and women and communities all over the country. The final point before I turn it over to Chang is that on page 22 and 23, one of the reasons why I continue my career at the Housing Investment Trust is because of our commitment to diversity. And just so you know, 61% of our staff is minority and women, 56% of our leadership team, including my brother Chang and myself, are minority and women. So, we also received a Diverse Manager Award from NYSERS. And this brings an incredible team of varied experiences and perspectives that add significant value to our fund. So with that, I will pass it on to Chang to provide some additional detail. Thank you.
Thank you, Leslie. Good morning, everyone. Thank you for this opportunity. I'm excited to be here. I'm Chang So with the Housing Investment Trust. Leslie and I have actually been working together for 26 years, not just 20, but yes, we've been on the road quite a bit together, and I am truly blessed to have her side by side, day in and day out. This is an incredibly important moment for the Housing Investment Trust to be here today. Primarily for the reasons on that slide there in front of you. As you can see, the HIT is invested in over 600 projects nationally. 70% of these investments generate more affordable housing in the communities that we invest in. The city of Chicago has benefited more than any other city. We've invested in over 70 projects. We just closed another transaction yesterday. And right now, today, we actually have close to 10 projects under construction in the city of Chicago, with more to come. Since the pandemic, the HIT has invested in close to 100 new affordable housing projects around the country. And again, in Chicago, the past 10 years, the Housing Investment Trust has created over 15,000 housing units. 75% of these housing units are affordable. 40% of these housing units are affordable to working men and women. I do want to touch on our investment merits, and I know there's going to be questions. My background is in portfolio management, so I'm going to talk to you a little bit about the portfolio and the strategy. The Housing Investment Trust is a fixed income fund. We are a bond fund. We are a mutual fund. We are regulated. Our inception goes back to 1984 as a mutual fund, but our history goes back to 1965, where previously we operated as a collective bank trust. The HIT seeks to generate fixed income returns versus the Barclays Aggregate Bond Index. For the past 30 years, Over 85% of the time, we have been able to outperform the benchmark on a gross of fee basis. And on a net of fee basis, it's been about 65% of the time. I'm pleased to say that year to date, we are outperforming the benchmark by 100 basis points. The past 1 year performance shows a relative advantage of 85 basis points. I will touch on some of these slides if there's interest, but again, we are a fixed income fund. What we want to do is we want to deliver a liquid product. 98% of our investments are highly liquid investments. Our investments are also high in credit quality. We've never had a single principal loss in the history of the fund. That's because 95% of our investments are guaranteed by the federal government, by FHA, by HUD, Ginnie Mae, Fannie, Freddie, et cetera. In addition to the safety and diversification, what we want to do is we want to deliver more yield. If you're all in treasuries, you're going to give up yield. The great thing about the HAT is you can have treasury-like safety, but you can have ag-like income. So we have an income advantage versus the aggregate index of 65 basis points right now. And on a net of fee basis, it would be about 35 basis points. So all in all, our portfolio is safer from a credit perspective. It's got more income and it provides better diversification versus most fixed income portfolios. The other important aspect of what we try to do is responsible investing. Leslie talked about how proud she is about the diversity and how important diversity is in terms of who we are, in terms of our leadership, our workforce. But if you look at the investments and the impact that it's making, overwhelmingly, it benefits women head of households. It benefits people of color and underserved communities because 90% of our investments are invested in underserved communities. So if you want action and you want responsible investing, I can't think of a better model than what we have in terms of the HIT and its mission. So with that, I do want to just touch on a couple key slides before my time runs out. Again, we're a fixed income vehicle, but we're very different. We directly originate housing development investment opportunities. We're not just buying the Fannie, Freddie, and Ginnie securities. We develop a pipeline when the site is empty, when it is vacant. We are working with city agencies. We're working with developers, for-profit, nonprofit. We're working with community leaders to identify investment opportunities. We're helping source federal dollars, state dollars into a community, not just using our money, but we're leveraging public resources to rebuild communities that need housing. So as you all know, we need housing not only in Chicago, but we need housing all throughout this nation. We need over 7 million units right now today. So the HAT has over 40 projects under construction all around the country. Every single worker on our project is a union worker. That's it. So if you want to make sure that the contractors dealing with your money managers have a responsible contractor policy, there should be no concern with us because every single worker on our project is a union worker getting competitive wages, benefits, and retirement packages. So with that, I am going to actually wind down my prepared remarks and leave time for some questions. Thank you.
Okay, we have 28 seconds.
I have 25 seconds. I just want to thank Leslie for being my partner for 26 years, not 20. So let the record note, 26 years.
I love it. I love it. Thank you for clarifying that because she said 20.
Well, you know, we try to keep our ages a little.
Oh, okay, okay. Okay. That's a screen. All right.
Yes.
No problem at all. Okay, Trustee Nelson.
Yes, thank you, madam. I don't know, I hear the sound, so I didn't know if it was my.
No.
At any rate, I am so impressed because I was at a meeting, Ward 21.
Yes.
And I don't know if it were you or someone else who spoke about the Imani Village.
Sure.
On page 10.
Yes.
So impressed. It's in the heart of the city. And so you are speaking about what we need in the heart of the city where there would be blight. So if you would like to just say a little bit more about Imani Village, because as I said, I was impressed with what they're doing because we keep asking for more within the city in the blighted areas and not way up north and or way west, but in the heart of the city. So just a minute, talk about Imani.
Sure. While I scramble here for my notes on that particular project, let me just make it clear. The Housing Investment Trust has 45 professionals. This is the only product we have. We are all focused on this product. Fortunately, we have a great team of real estate professionals and underwriters. I was not a direct on the Imani project, certainly as a CEO.
Oh, well, if you don't have the specifics, that's okay. I just wanted, because in the presentation, so many things were included within this particular area.
Sure.
The housing and the medical was, within that area. It was, okay, I'm just going to be quiet about that.
Yeah, well, what I would love to do in response to that, if we can post up slide number 12, I think it'll really resonate. You can see there's a map of Chicago, and all the green dots or squares are areas, neighborhoods that we've invested in. So again, historically close to 70 different projects throughout the city. Another exciting project is Grace Manor Apartments. I'm not sure if you heard about that, but that's in the neighborhood where I actually learned something where Dr. King, during the civil rights movements, he moved into that neighborhood to highlight and to bring attention to the fact that we have communities that need investment, right? But it took us 60 years. All right, it took Chicago and America 60 years to go back to that community and to make an investment. So there's actually this beautiful building that is being developed, all affordable into this neighborhood. We do that story after story, deal after deal. We work with community stakeholders. We make sure that the community is behind that. We also work with state and city agencies that control tax credits, tax abatements, right, grants, et cetera. So again, the development teams that propose to work with us, we make sure we screen them, and we want to make sure that every investment that we touch improves and brings light into communities. But Imani Village, along with the 70 other projects in Chicago, you can see is something that isn't going to go away. I'm excited to say that I have 6 more projects that I'm likely to do in the next 12 months in Chicago. So one thing that is really important that I hope you all get excited about, in addition to the investment updates you would get from the HIT at meetings like this, we would like to forge a partnership and relationship with this pension fund. We would like to tell you about a groundbreaking. We would like to show you our pipeline so that you can tell your teachers, your students, and your community members that, hey, the Chicago Teachers Pensions, we're going to help support and finance this project. Here it is, Imani Village, 200 units, 80% affordable. Here's the income range, and get the word out so that if people see investments being used this way and successfully, others will follow. And we can now take 70 projects and turn it into 150 projects and so on. So I know that wasn't exactly what you wanted to hear, but as a follow-up,
that was good.
I could deliver to each and every person here a profile on Imani Village. It will tell you the exact address, the development team, what type of housing, the surrounding neighborhood, market data, et cetera.
Love to have it.
We would love to have
Thank
that.
you.
Send
In
it.
fact, I can send it right after we leave here and email it to Fernando, and maybe he could distribute it to the team. So we'll have that to you within 15 minutes.
Oh,
All right, thank you.
and so just one last thing to say is that we've had many come in and tell us that they're building houses all over the country, but never in Chicago. So I was just happy about this. Thank you.
It's definitely a key market. And as Chang said, we've got some things that we're looking to close relatively soon. So we would love to have you guys in as a partner.
Yeah, and by the way, I'm struggling with my reading glasses. I just started using them. I did find my notes there. Imani Village Senior Apartments. It's affordable to senior tenants, 70 units, for tenants that are 62 and above. All right, and it's on a 23-acre site in the historic Pullman community, as you know. So again, on our website, we also have profiles and renderings of what it's going to look like.
Okay. Trustee Benson?
I was just curious because the article that I read about Amani Village said that it was actually Trinity United Church. So how does that work? So they came to you
Yeah.
for investment. So your return is to this rental property. How are you
Great
making money?
question. Yeah, so Trinity and other for-profit, nonprofit developers, they are the owner and developer. They look for financing or technical consulting to help pull together the capital needed to develop. So they have the real estate risk. They come to us for the construction capital, the mortgage capital. So what we try to do is we try to underwrite the maximum dollars that they need to complete the construction. And what's also really unique about the HIT is we don't know where interest rates are. So if you're a developer and you're facing higher interest rates, you spend years, sometimes decades, getting everything ready, and then you're afraid that interest rates might rise when you're done with completion. How are you going to make it work? So we actually also provide the permanent mortgage takeout of the construction loan so that the uncertainty of where interest rates are to the development project is gone. That's why in 2008, when anybody that was in real estate or housing crumbled and got crushed, we shined. We don't take interest rate risk. In fact, we take that off the table. And then what we do is we allow deals to move forward because you can address the interest rate risk. But your return will be income from the mortgage payments made by Trinity and the developer that actually owns and operates the project.
Trustee Ochoa, followed by Trustee Woods. Oh, and then Trustee
So
Washington.
thank you for the presentation. I think we all share your enthusiasm for the affordable housing. And I think the only concern I have is where it fits in our portfolio. So you have stressed that it fits what you're presenting for. I don't see in your slides something against the index to see when it performs, how it performs. And
Absolutely.
So our diversification, we want to have something that performs during crisis and make sure it does what it does. I think there's some willingness to consider you for another part of the portfolio too. So I guess I'm trying to figure out how you perform against the index during rough times.
Oh, that's probably my favorite question in the world outside of how are we making an impact. All right. All right. I'm gonna point you to slide 14. And what we try to do is we really try to just simplify the comparative analysis that needs to take place in making this investment decision. So the Housing Investment Trust is compared to the ag right there. The ag is a representation of investment grade fixed income, as you all know. You can see that we are 95% actually government credit. Okay, so when times are bad, you want government credit. We don't have corporate bonds and credit exposure in our fixed income portfolio. So number one, you want to make sure that this is investment grade. We're better than investment grade. We're government grade. All right. You can see that our credit rating, therefore, is better than the ag. You can see our yield relative to the ag. So we're going to be a lot like the ag plus more yield, more income. And then is it a bond portfolio? Absolutely, because you have that effective duration. We manage our interest rate risk relative to the ag actively, and our policy and strategy is to be neutral. So our duration is 5.97 versus the duration of 6 for the ag. So when interest rates go up, we're going to suffer like a bond. When interest rates go down, we're going to really do well and provide that diversification. Now, do you want proof in terms of how it performs historically? Absolutely. If you look at the calendar year returns on page 20, look at 2008, when fixed income did well, but most active fixed income managers, as you recall, did really bad. They were actually negative if you go back and data mine for it, okay? The Housing Investment Trust actually outperformed the ag by 60 basis points or so in 2008, and even more in 2009. If you go back to 2001 and 2, again, the '01 crisis, recession, okay, we outperformed. If you go to the first quarter of COVID in 2020, we were one of the best money managers, period, because when there's a flight to quality, you're going to have a flight to U.S. Treasury credit. So if we are delivering a disciplined duration of 6, which is where the ag is, you're going to get a bond-like performance. Over time, you're going to get a little bit more yield. When there's a recession, when there is a crisis, I promise you, we are going to outperform almost all active managers because we don't have corporate bonds. We don't have Walmart in our portfolio and their credit where you have to be like, whoa, what's that mean for their sales and their revenue? So again, we rely on the full faith and credit of the U.S. government. And then some people actually start to fear that our credit quality, the U.S. government credit quality, is going to be downgraded because of the debt. Well, guess what? We're in a better position because not only are they on the hook for your money, every unit will be leased up because our projects are affordable. There's subsidies, there's grants, there's a mortgage. So there's incredible diversification in our portfolio, and that's the value added. So I'm glad you asked that question. It doesn't look exciting. It's a bond, it's fixed income, it's investment grade, but it's really diverse versus any other bond strategy that I guarantee you that you can put us up against.
Well, I appreciate the response, and I think the slide 20 is a good showing of what you were just saying. Thank you.
Yeah, and by the way, 366 different institutional investors, public pension funds, union pension funds, UAW, $60 billion Viva fund, they all have us in their fixed income buckets.
Trustee Woods.
Yes, thank you so very much. I appreciate your presentation. Even though I had stepped out physically, I was listening and very excited. I have to note your enthusiasm when you walked into the room was infectious and contagious, and certainly show your dedication to what you're sharing, and that's appreciated. I'm delighted to see a Black woman and an Asian man sitting in front of us. I mean, that is not unnoticed, and I think it speaks volumes about your commitment to diversity, not just in word, but also in deed. So thank you for that as well. This is a very touchy kind of space in a lot of ways, right? Housing is huge, right? It can stir up a lot of emotions about where we put our money. So I'm probably going to take a departure from my colleagues and not talk so much about the dollars and cents, but kind of the philosophy behind the fact that we are a city and a state that struggles with homelessness, where we have literally since COVID vacant units all over the city, and yet still people sleeping on the streets. So as you are continuing to grow our dollars by building new projects, are you also paying attention to, or is there any thought to what's kind of happening boots on the ground with people who are still experiencing being unhoused? And are there any partnerships with community-based organizations or folks like Chicago Coalition for the Homeless to say that even while we're building these fantastic new construction projects for people who can afford housing and can afford a great mortgage, what about the other folks who maybe cannot? Is there something?
Sure. Again, the housing and homelessness crisis around the country, it's never been worse. And we're seeing this in every city. It's getting worse and worse. The HAT tries to leverage labor's presence in the community, whether it be through working with the AFL-CIO, CLCs at the local level, whether it be working with the local building trades councils and their connection to community organizations. Again, even though we're a $6.6 billion national fund, our office is 45 professionals. We have a lot of areas that we need to touch, but what we do well is we leverage labor. One of the exciting things that we started to do is we started to partner with labor at the local level in identifying and developing legislation, trying to get mayors and governors as part of their housing plan that they often promise the voters in terms of what they're going to do to improve the housing supply coming online. We give them ideas. We show them actual projects that work over and over, and they say, wow, I can get jobs, I can get housing. How do we do it? And then what are you giving back? And we say, well, we're putting $6.6 billion on the table because many of these vacant sites need capital. They need long-term partners. We've been around for 65 years. We're not just showing up and saying, hey, we'll buy a piece of that mortgage after it's done. We're going to work with the development team. We're going to work with the city. And right now in New York City, there's legislation up in the governor's office in Albany right now that we help draft and formulate that is asking for several $1 billion of state funds to leverage our dollars. And then it will have responsible workforce standards, as well as we have given large communities heads up that, hey, you need housing. This is coming. Call your local senator and say that you want this bill. And so that's kind of how we get involved with the community. Certainly the Trinities, the developers that are actually on the mortgage or on the deed, they're going to be more involved and connected with the community resources. But we certainly are working with labor and repeat customers and clients to try to do more with the communities. But it's going to be endless. There's just too much to do. And we're open to any ideas, but we are working really hard in New York and in California in getting legislation to identify more dollars to create more housing in underserved communities.
And we do have a track record of doing transitional housing as well. I think that's what you're talking about, people that were formerly homeless in various communities. So as long as it can be structured to benefit the portfolio, and we've proven that we can make that happen, we're definitely interested in doing it.
I am a firm believer in walking and chewing gum at the same time, so I have the utmost confidence. I also want to say thank you for that answer, especially the part about working with legislators around creating policy, because that policy kind of gets at the root causes of what the problems that we are facing. We are in a city with a mayor who has a very vocal commitment to the unhoused. So, that's something you'd want to pay attention to as you are also looking at the other cities that you are having a presence in as well. And so thank you.
Absolutely.
Mm-hmm.
Trustee Washington.
Good morning.
Good morning.
So I have questions. I don't have time to have all the questions I've written, but I do have a couple. So to the point that was just made by Trustee Woods about the housing and everything, I'm wondering about housing for the unhoused. I'm wondering, and I'm going to kind of rattle a little bit, so please keep up, I hope, or try to keep up. I'm going to try to keep you all focused with me. Because my wonderings are, what type of leverage or influence do you all have within the spaces that you are essentially loaning money for these projects for specific types of projects, right? So like I'm thinking about how can you leverage your position for housing for the unhoused? Like we got all these vacant school buildings all over the city. And in my head, I see transitional housing for the unhoused in those buildings around each community where you have people that are unhoused, right? But how do you finance that? Don't know, but I'm putting that in your lap. So also, when I think about leveraging the ability to, you're essentially underwriting these mortgages, correct? For these types of projects. So what does that look like for workforce housing in a city that requires that we live in the city, but I should not have to be a renter in the city at an affordable rate? I want to be able to purchase where I'm living, because for the most people, that is going to be your biggest nest egg next to your retirement fund, or, I mean, we have a pension, thank God for the pension. But aside from the pension, what else do you have that you're going to leave and pass on to your children or your nieces and nephews or to the family pot to bring each generation further and further along? For most people in this country, it's their home. That was the American dream, was built on, you got a good job and you built a home. That home built value. That value was passed on to the children so the next generation can build off of what you left them, and so on and so forth. We're losing that in modern times because of the income inequality, Income inequality, the wealth gap is so significant, and housing is driving that. So you all are backed by 95% of what you're doing is government. So how can you leverage that? And I don't know if it's even well, I won't say as simple, but if it's something like creating a mortgage product that is specific to workforce, people that work in school communities or not just school communities, but people that are government employees working within that space. Is that something that you all can do to not only impact what's being built in the area, but also provide an opportunity for people to build wealth? Whereas the fund is still generating the yields off of the investment on the mortgage, but you're also helping individual people and families build wealth for their family by way of their housing. That was another musing I had. And I had one more, but I can't read my scribble scrabble. And so give me just a second. Oh yeah, and then the fees. So can you talk about your fee structure in this
That's a question.
type of thing? I just had an industrial cup of coffee. And this just perked up my interest. So I'm so excited about what I've heard. And so, yeah.
All right, I'm gonna do my best, but I really wish I had some of your coffee as
It's
well.
delicious.
I love it. Yeah.
My secret, by the way.
So let me start with the home ownership interest. So 80% of our portfolio is invested in multifamily mortgage-related investments. So rental housing is really our primary focus. And I couldn't agree with you more. I think the key to America's success in terms of its economic growth in the 20th century was home ownership, right? We had 65% home ownership. And then if you recall, before 2008, the home ownership rate rose to actually an all-time high of 72%. Unfortunately, that was escalated by poor underwriting, right? Predatory lending, et cetera.
Yes.
Prior to 08, from about 2002 to 2006, we had a number of different home ownership programs where the HIT partnered with large financial institutions to offer advantaged rates to public workers, teachers in New York City, in the state of Washington. And then we had a national program with the large institution that didn't survive 2008. We didn't have any direct credit risk. We certainly generated hundreds of thousands of mortgage loans that otherwise might not have been possible. We are discussing internally right now how we can roll out home ownership programs again, because as you all know, the supply of homes for sale doesn't exist. And if you can find a lot or a home to buy, mortgage rates are 7% versus 3% where it was just a couple of years ago. So we do think that it is going to help not only Chicago, but it's going to help working men and women to be aware and to have access to mortgage programs. So I know that we had a particular program here in Chicago. It was the Pro Loan program where for subdivisions, the HIT would commit to rate lock for a whole year, a home mortgage. Because if you're a middle income family and someone's building a home and you can afford it, but you don't know, they're not going to be done with it for a year, how do you know where rates are going to be? So that program was successful. So we're actually revisiting how we can leverage our experience there. So we're very, very open to any ideas. We're flexible. It will require partnerships and engagement with teachers and other unions. And by the way, many of our investments and projects, the developer is a union. It's a local union that had access to the land, or a nonprofit that was, a venture of several different local unions. So what we've done over and over is we've partnered with unions where they say, hey, we want to build and develop a transitional housing project, all right? Help people get off the streets and transition them into the next phase. So again, we have a website. I invite all of you to look at our projects, look at her videos, the testimonials. I also invite you to take a look at this map and actually drive through Chicago and see how many sites are up and how many people are living in these projects. Pretty good diversity in terms of the types of projects. Again, in Chicago, I believe it's about 42%, 60 to 80% AMI, and 36% of our projects are workforce housing projects. We need to do more there, but it's really challenging. How do you make something affordable to workers when the subsidies and public programs really don't have anything available for working men and women? Right. So again, this is why we're trying to get public funds, especially teachers now that are facing this crisis, to leverage their pension dollars and take the lead and say, hey, we got to promote investment in workforce housing, because right now there are really no government programs that address it in a meaningful way. So we certainly do it, but there's not we need public resources there. So the partnership that I'm talking about is, hey, let's get a meeting in the mayor's office. Let's talk to the governor's office. How do we come up with the pilot program, right? And you all know how to lobby. We'll give you the ideas. We'll offer some technical advice. We'll bring housing experts and developers all to the table. They want it to. Let's create programs, and we'll bring our dollars into it. Hopefully, I addressed a couple of your questions. I'm going to come back to the fees. So we're really uniquely structured. This is the only product that we have. We basically operate as a cooperative. So our board, which is primarily comprised of labor leaders, mostly national labor leaders, including Liz Schuler, president of the AFL-CIO, and Fred Redmond, secretary treasurer of the AFL-CIO. We have a board composition of about 16 board members. They approve an annual budget. We just pass on our operational costs. There is no margin. There is no retained earning. There is no corporate take. We're not on commissions. We're not on bonuses. We are regular workers, Leslie and I. That's why we're still working after 26 years. But no. It's great work, but we pass through our operating costs, and I'm just going to jump ahead of the anticipated question and say, well, other bond managers charge less for a core strategy. Of course, they're not spending years with the developer talking to city stakeholders and involved with the community in bringing a project into fruition, right? And we're not asking for a charity check. No, this is for all of you. We're bringing value to your community. We're bringing value to your beneficiaries in the form of more yield and more income, more safety in terms of the credit quality. We've never had a loss, even through 2008. And most of all, we're improving the housing stock of Chicago, the tax base of Chicago, without any additional risk. So if there is a recession, if there is a downturn, you're going to get the government credit quality protecting you. You're going to get more income in between. So there's the value proposition right there. But the fees are about 32 basis points. And yes, it's technically a fee, but it's really just passing through a cost. It's a cooperative.
Can I ask one more follow-up? Okay. So.
Because I wanted to know if you get a range of.
Sure.
And if I heard you right, go back to something that one of the questions that Trustee Washington. All of this is rental housing.
80% is rental housing.
Rental housing, but we need people to own.
We agree.
Because you know what, rents can go up. They cannot afford it. And then it's no longer affordable housing. So that is my concern, but the range historically with HIT, is that where it is that's.
Jackie, turn your mic on.
Sorry, is that 32 basis points?
Yeah, so that's a great, so on the last 5 years, it's been 32 to 33
Thanks,
basis
Mary.
points. The last 5 years, it's been 32 to 33. I was appointed to be the chief executive officer 5 years ago. Previously, I was the chief investment officer, and I have been doing this with Leslie for 26 years. And when I got the opportunity to be the CEO, I made a commitment to make our operations more efficient. So we historically, Prior to 2018, our fees were about 42 basis points. I delivered on the commitment. We brought it down to 32. We're trying to grow the fund so that we can continue to pass on the economies of scale to all of our investors. As we grow, we anticipate those fees or expenses to go down. But right now, for the next year or two, it would be 32 basis points, and we anticipate that going down gradually.
So can we talk about that 20%? So you say 80% is rental, so the 20% I'm assuming is owned?
So about 15% of our portfolio outside of the 80 is in single-family mortgage-backed securities. So that's the window that we would be able to try to establish some home ownership programs. And then we have about 5% in treasuries and other investments, to make sure that we take advantage of fixed income value. But our core competency is in multifamily. We also have a lot of experience in home ownership programs. So we're very open to doing that. And I couldn't agree more. We have to start making it a lot easier for working folks to be able to buy their home. But it really starts with, we need more affordable housing, period, workforce housing, so you can save a down payment by paying less in rent. If you increase the stock of rental housing available for workers and moderate income wage earners, all right, you allow those people to get their feet off the ground and to have a down payment, have the credit score to get into a home. But then you got to follow through. You got to have mortgage programs that teachers have access to, that nurses have access to, that are in addition to what's already out there. So we're very open to that, and we have experience doing that.
And to that point, then, and I promise I'm through.
No, I just wanted to jump on that. You're saying that the 15% that's mortgage backed securities?
Yes.
Okay, so that's the mortgage backed securities. And then you have on page 12, commercial mortgage bond securities.
Yeah, on page 12. All right.
Right.
Let me just flip back there real quick. It should be just cash and treasuries, the remaining balance, page 12, or is it? 13?
Yeah, well, wait a minute, in my book, let me see what page you have it in.
Yeah, because it's different on this.
Yeah, so we have 3% in treasuries, okay, and we have like 1%, 1.5% in cash. So we just rounded up to 5.
Okay, so what is the additional 5%? And Quentin, I'm gonna let you get back to that. The additional, because that's 15%, and then you have 5% where?
Let's see. Well, at least the way we break out on page 15, it's going to be 80% multifamily when you combine different aspects of the pie chart. But again, we're going to be 85% in multifamily, about 15% in single family, and the balance in treasuries and cash.
Okay.
Yeah.
Can you go to that? And then I just
we don't have any like direct commercial real estate or any material CMBS. I don't know if that's what you were concerned about, or if we don't have any exposure to that.
Okay.
So back to what you were saying about the ownership stuff. So in my head, as you were talking, what I heard you saying, or what I heard as a possibility is, when we think about mortgage-backed securities and things. So we're building these units. Well, the units are being built, and just like there's a certain amount that has to have, affordability. In my head, I see that it could be structured whereas a certain amount can be affordability, but also a certain amount has to be provided where maybe it's not mixed use, but some of it has ownership. Some of these units are condos or co-op, or more so condo maybe, where people can purchase the unit that they are in, and it's still a mortgage-backed thing. It's still being built where you have some rentals, but where people have the opportunity to invest in owning their space. Because there are a lot of people, especially nowadays, that would probably rather have the benefits of home ownership, the benefits of a condo or HOA, where they're not worrying about maintenance and stuff because you have an association to do that. I also know that with mortgage-backed securities, particularly FHA, most condos don't qualify for FHA-backed mortgages because of the restrictions of the association and everything. So to that point, in my head, in what you all are doing, and I don't have the answers. Actually, I have a couple of them in my head, I think, but structuring it in a way whereas for workforce housing, there are things that are programs that are special and specific to workforce, loans that are specific to workforce. The lending criteria may not look the same. The income criteria may not look the same as it would for the general public, because where we give subsidies to people that are living in lower income housing, but that subsidy is basically benefiting the owner or the corporation to make sure they're still getting their big pot. So why are we not doing something similar for your average everyday working people that may be a teacher's assistant in a classroom making $40,000 a year with 3 or 4 kids at home, the single mom that is the lunchroom manager that's paying all this rent? These are the people that I'm thinking about. I make a decent salary. I'm a single man with no children. I got a mama that likes to come across that alley and get stuff for me because, hey, I'm the oldest. It's what she does. And I can make some decisions because I'm a single person with no children. But I have cousins that have 2 and 3 kids that they can't make some of the decisions that I do. And so I'm thinking about those people. How can we leverage these dollars to make those things work for those types of, for those individuals, while also stabilizing communities? Because when you have all of these, because that's the bigger problem. And I'm looking at the bigger picture when you have vacant homes and vacant lots and all this stuff in these communities. And then you were wondering, well, why is the crime the way it is? Well, it's a whole, take a look around, take your pick of why things are the way that they are. So I'm done with the soliloquy.
Where and
where.
Where there
But
are.
I guess my major point is, as I'm thinking about this, how can you leverage these dollars in a way to be creative? Because this is going to take a level of creativity to the point that you made, even if it means sitting down with the governor, the mayor, whomever, and figuring out, what do these products look like? Like when they used to have, back when I first started in CPS in the early 2000s, they had the Teachers Next Door program and the police officer next door. If you worked for the police, you worked for the city, they gave you those HUD homes for like $1 or something. You got it at a reduced rate. They gave you the money to do the renovations. So what are those? Why are we not looking at those types of programs? Not maybe that may be dead and buried and it may need to stay there, but why not create and birth something that's just as innovative and can be way more impactful for the school communities that people work in, so that our students have somewhere that they can live that's affordable, where their parents aren't having to travel crisscross the city to try to do the basics just so that they can keep a roof over their head.
I want to just add to that. What is affordable housing? Tell me what your affordable housing is in dollars, because affordable is still unaffordable for some people.
Yeah, so we don't have our own definition, right? Because every market, every neighborhood, and every city, has different area median incomes. And generally, people will reference the median income of that local market. So again, we track all of this. We don't say, hey, this is 120% of area median income. It's too expensive. We're not going to fund it. If we see demand, like in New York City, you can get up to 200% area median income. Teachers can't afford that, right? We don't have a definition for it. I will say about 70% of our investments are affordable at about 140% of area median income or lower. I would say 50% is between 60 and 80% of area median income. So it really depends on the local census information. But I will tell you, when you said why not, there is no answer for that. We have to do all of this. We have to do more of it. We just completed a project in Honolulu, Hawaii, and it was a tower. It was condominiums, all ownership. And it was 100% workforce, between 120 and 180% area median income, right? So imagine being able to buy or offer a worker that's earning, let's say, $80,000, $90,000 a year as a household, a chance to have a home at $220,000 in Honolulu, Hawaii. So it can happen, but you got to have policy and legislation. You have to work with the city. You have to work with the state. You have to identify vacant land. You have to figure out how to attract more resources dedicated for workforce housing. And then you have to bring in the private sector capital like ours and say, there's the mortgage loan, here's the land, here's a tax incentive. Let's build some housing for workers.
Yes, I'm sure we probably have a whole lot more questions and.
Should I get a hotel room from tonight?
You might need to go right across the street. But no, we do have a lot of questions and we are looking at how this fits, into this strategy. And as well as, I just have issue with everybody has a different concept of what is affordable housing. Okay. What's affordable in your mind or in the government's minds or in your program mind is not affordable for what's happening out here right now today. We are seeing more and more and more homeless people. You are seeing more and more people standing on the flower beds because they have children with them and they are asking you for $10, $15, $20 so they can go and buy something to eat. They don't have a place to live. And I think that I would like to see something where if it's going to start out rental, why can't they build some equity? Build equity and then take that equity and go and buy something. This is what we have been kind of focused on this board, because if you have, just the rental housing, no other options, still people have no place to live because they can't even afford that. So I do, but I know we are way over time. So I am going to end this. Okay, but 30 seconds because we are way
I
past
need less
time.
than 30 seconds.
Okay.
The idea is that came to my mind that we do have a real estate bucket also.
Yes, we do.
Besides this particular
Yes.
bucket. So see, less than 30 seconds is that if they, are not within this particular, that, perhaps.
And that's why I said
That a
that.
future, and that's why.
That's why I said that. And by then, maybe we could start having some of these conversations with the mayor and,
Absolutely.
we need, this is like a 911 emergency
Yes, it is.
in our eyes. So maybe we could do that.
Absolutely.
But please forge forward with that because I would love, love if this had more components. This is exactly what we're looking at. But everything on your map is rental, correct?
Yeah.
And I haven't even seen a map with Inglewood on it, to be honest with you. I haven't seen a map or a project that is only on Cottage Grove. Now that project down there, they have programs where they can accumulate equity and then they could buy.
This is South Shore.
Yes,
Yeah.
yes,
I
yes,
know.
exactly. You know what I'm saying? Yeah, exactly. Okay, so I'm gonna end this because, as I said, we're about 15 minutes past our things, our time frame. So I want to thank you all. This has been a very invigorating conversation and what is definitely our interest. So I'm going to ask Fernando to come up and thank you so much. And you all have a great day.
Thank you. If I could just thank you also, and we're looking for that information.
Yes,
Okay.
absolutely. Yes, absolutely.
Yeah, I'll get that for you.
Absolutely.
As soon as I walk out the door.
Thanks again. Have a great day.
You are
Thank
quite
you.
welcome. And we look forward to doing business. Yes, I think you have some great ideas. We just got to get that money right
That's right.
and that product right.
Plus.
Damn.
That was just me being cold.
Yeah, no, I was gonna see if, I was looking for clean.
Oh, no.
All I got is my.
Thank you all. That was trustees. That was a really relevant conversation. rally appointment points. And this is what we have been kind of focused on. So we're going to hear from Fernando. For recommendation.
We'll probably do B and then move C to the vote agenda.
Okay.
I'm
So
super.
let's do,
Don't we have one more? No.
we're gonna do B. No,
What?
yeah, we just had four. We had it all four.
That's four for this presentation. We got something else. That's late. Okay.
Okay, so just to summarize again, three are very quintessential core fixed income managers, and as you saw with AFL-CIO, they benchmark themselves to the ag, but it's very much real estate focused. So if not here, potentially they could find a home in a real estate search that we do when we go out for both equity and debt. So I don't know, Tony, do you want to add anything to?
First on the last presenter, I have a pretty extensive history in a previous life with that product. And just to demonstrate the unique nature of that product, we used to put them in real estate debt searches. And I think you could make a valid case that it's real estate debt. I think you could also make a valid case that it's core fixed income. And you could even make a reasonable case that it's private credit. So that's not to say unique is a bad word in this sense. The problem that we have with the way we define core fixed income, not to say that it's not core fixed income or other plans don't see it that way. Our problem is structurally. Because this is only offered in a commingled fund, we cannot have our own separate account. We don't have that anywhere else in the portfolio. What does that mean? One, it means that the fees are set at the commingled fund level. So that 32 to 33, that's set in stone. There's no negotiation. That's what everybody gets. It's like going in a mutual fund. That is, and I know there's fees that were, we negotiated ahead of time that we're not displaying here, but that's double what everybody else has come in on this particular search. That's also double what we've negotiated with our existing managers. So for us, that just presents a structural hurdle. How can we put something into a core fixed income bucket where they're coming in double fees? The other issue with this commingled fund structure is because you're in with everybody and we don't have our own separate account, they have told us flat out they can't meet the 25% minority brokerage goals because they have to do it at the fund level and we don't have our own account. They can't meet it. So again, that would be making an exception within core fixed income. We'd be violating, one of the kind of steadfast protocols that we have in place. So again, I think, as a number of trustees have alluded to, there are, it's a fascinating product. There are other places that we're looking at where this would potentially be a fit. And I'm thinking back to, the affordable housing First Friday educational session that Fernando kind of led. Just be mindful that if we put it in that bucket, it's going to be like the lowest cost, most liquid part of that. It'll look different from those, but that's not a bad thing. But I think, as Fernando and I have kind of talked over this, nothing against the strategy. We think there's definitely some areas that fit, but I think for this particular search for core fixed income, how we define it, it presents some challenges that I don't think we can overcome.
I'm sorry, I was trying to fix in my head, how this could fit and not violate our policies, not just blow them up. So thank you. You said exactly what I was thinking, John. So I think we want to have a change in the agenda because
what are we doing? Do we have a vote here? Oh, no. You want to put it on. So motion to.
Okay, so it is, yeah, we need to do that. So that's why we were talking about, you wanted to do B or?
I was fine with Luke.
Okay, all right. Okay, well, why don't we do this? Why don't we look at do our straw poll, because has to be done in ocean, or do what we're thinking. I want to hear what people are thinking as far as about the three that have been, that fits into this asset class, which is Loop,
Longfellow and Merganser.
Longfellow, and Merganser. And Merganser is, that one is, yeah. Loop,
Merganser, by the
Longfellow,
way,
and
is a duck.
Merganser, yes.
I was trying to figure out what Merganser meant. It's a duck.
We have to make a motion.
Okay, so then I make a motion that we go with Loop.
Okay.
Second.
Okay, so it has been properly moved and second that Loop Capital has been moved. So anybody have a roll call vote, or did anybody have anything else to say? Because it's already, yes.
I wanted you guys to address the commingled options or just one group. I mean, any concerns? I heard you about the HTI being for another sector. So then is it best here to pick just one? Yeah, okay.
Thank you. So can we have a roll call vote?
Who was the second?
A Loop Capital has been moved.
It was made by
It's the,
Trustee Washington.
Trustee Washington, and second by Trustee Nelson.
Thank you. Trustee Barajas?
Yes.
Trustee Beza?
Yes.
Trustee Blackwell?
Yes.
Trustee Nelson?
Yes.
Trustee Ochoa?
Yes.
Trustee Price Ward?
Yes.
Trustee Riley?
I'm sorry,
Yes.
yes. I'm sorry.
Trustee Rodriguez?
No.
Trustee Benson?
Yes.
Trustee Washington?
Yes.
Trustee Woods?
Yes.
9 ayes, 1 nay.
Thank you. We're a little bit behind. I think we need to break to lunch because lunch has been here for a while. If you don't mind, we'll move C to the
Sure.
opening after we come back after lunch.
Will do.
Okay, thank you.
Thank you.
Thank you, John. Thank you, John.
Thank you.
Okay.
Let's come back here.
12:45. So what? 1:15 or 1?
That'll give him a little bit more than 45. Last one forever.
We'll come back from lunch at 1:15. Is that okay?
That's fine.
Okay, sounds good.
Okay, 1:15, we'll be back from lunch.
I saw that resume. I don't know. They probably crazy. Okay. Jeffrey, I need a minute. No.
I know. Give us all a minute.
Do we need to do roll? Just, yeah, let's do a quick roll call.
2,100 square foot house.
Roll call, trustee Barajas? Present. Trustee Beza?
Present.
Blackwell?
Present.
Trustee Nelson?
Present.
Trustee Ochoa?
Present.
Trustee Price Ward?
Present.
Trustee Riley?
Present.
Trustee Rodriguez?
Present.
Trustee Benson?
Present.
Trustee Washington?
Present.
And trustee Woods?
Present.
That concludes roll call.
Okay, thank you. Before the presentation, let's get the motion on the floor. So I'd like to entertain a motion for approval of High Vista Fund. I cannot see that little print. 14, thank you. I was struggling with that one.
I'm sorry, President Blackwell. Can you please repeat?
Before the presentation from Fernando, I'd like to get the motion on the floor for approval of High Vista Fund 14 follow on. Oh, you still can hear?
it's still bad.
Oh, wow.
It's the way this is up
The
here.
setup here.
Okay, the motion is to, for approval of High Vista Fund 14. You made it. Trustee Vincent's made it, and Trustee Brown seconded. Here, Tanya.
Got it now.
Okay.
Reading and listening and matching the words. High Vista. Okay.
Oh, okay, got it. Now we have like, no, seriously, we've talked about this. Is there anything we can do to get the ceiling, something covered? We can't, your voice is all echo and we miss, so it's not, it was not just me.
I can vouch.
Thank you.
Okay, so High Vista, this is a re-up or follow-on investment opportunity with a manager we have invested with 3 times already for a total of $65.5 million. They used to be called Aberdeen, but since they were purchased in 2023, they're now doing business as High Vista. We invested in their venture capital fund of fund platform in 2018, 2020, and 2022. All 3 of these funds are smaller in nature. These are not multi-billion-dollar funds. Each fund is about $200 million each. And we're now asking the board to invest $10 million in Fund 14 because of our reduced pacing strategy. The folks presenting from High Vista today will delve a little bit more into their strategy of investing in managers who then invest in primarily 3 main areas: IT, biotech, and blockchain technology. So with that, and they'll also discuss, of course, recent performance. We'd like to invite them in to present to the board.
And we'll adhere to the time. We got a long afternoon agenda.
We're gonna do 10 and 5. You want to do 10 and 5? 10 minutes for the presentation, 5 for questions?
Yeah.
Okay. Good afternoon.
Good afternoon. How are you today?
Good to you.
Great. Good. So we have been asked to keep our remarks to around 10 minutes, so we will be as succinct as we possibly can. But we're thrilled to be here to tell you more about our plans for Fund 14 and also delve a little bit into the performance that we've generated on behalf of Chicago teachers in some of their earlier commitments to our firm. My name's Kirsten Morin. I co-lead our venture capital investing strategy at High Vista, and I'm joined today by another partner at the firm, Caroline Page, who is the head of relationship management. We've included a couple of the slides that we were asked to include here, and certainly open to answer any questions that you may have about them. But I'll dive right into a little bit about our history, which is on page 4 of the presentation. Our firm has been investing in venture capital for 30 years, going all the way back to couple slides back, actually, sorry, I think different public version. Going all the way back to 1995. And as I was sitting waiting to come into this room, I was ready and prepared to talk about our longevity of engagement in the industry until I realized that was the very same year you were celebrating your 100th anniversary at Chicago Teachers. So we have a lot of longevity, but not quite as much as you do. Over that time, though, we've allocated $3.5 billion to venture capital fund managers across 19 funds and have generated very strong performance on behalf of the clients that have entrusted us with capital, a 2.6 times multiple of invested capital net of all fees. On the next page, we've included a summary of our team at High Vista. I've personally been part of the team for 19 years. And as I mentioned, I co-lead our venture team. The top half of the page includes other dedicated members of our venture team, along with other individuals on the bottom half that support the monitoring and other operational aspects of our strategy implementation. We've included a relationship summary slide on the next page to just give you an overview of our relationship with Chicago teachers over time. CTPF has invested in our 3 most recent funds beginning in 2019, and we're currently in market with our 14th fund,
and hope to continue our long-standing partnership with you. The performance to date has been strong across the funds that you have committed to, and they're exhibiting good progress in line with what you would expect for their stage of maturity at this point. I'll provide more detail by fund in the ensuing slides, but for now, I'll turn it over to Caroline to give you a bit of an overview of High Vista.
Great, thank you. So we wanted to put, just for a minute or two, put in context the venture program within the broader High Vista strategies. High Vista is about an $11 billion asset manager focused on the alternatives universe. We're based in Boston, and what holds together our investment program across the various verticals, including venture, is a focus on finding and then building very deep expertise and capabilities in markets that offer structural inefficiencies or maybe harder to access areas that we think have the potential to deliver very durable, strong returns and outperformance, which we would call alpha for our client portfolios. So across our firm, we've been investing, as Kirsten mentioned, the venture strategy goes back many decades. The rest of the High Vista program does as well. And alongside our venture program, we have a private credit, small buyout, private equity program on the private market side, and a biotechnology-focused public markets strategy. Sitting above that, we have a multi-asset capability that helps to inform how we see the entire investment landscape and helps to think about even when we're investing in narrower areas. Just in terms of our client base, we have a very diversified client base, as you might expect. We have clients who have invested with us across all of the major institutional investor types, including a number of public pension fund clients. I'll note also we've highlighted a few local clients where, we wanted to highlight that we have a lot of familiarity. We spend time in Chicago, a number of clients here. We're also very familiar with working with clients who have Illinois-based, specific parts of their investment programs that we can incorporate into what we're doing on behalf of our clients. On the next slide, we've incorporated some statistics on the left to show for High Vista as a firm, and on the right to talk about our venture program. And diversity is an important piece of our firm and an important piece of how we think about finding and investing with and partnering with underlying fund managers. On the left, we're showing firm-wide the statistics for our firm as a whole, the partnership, the leadership of the firm. We have 14 partners, employee owners of the firm, as well as the venture team itself. And we know that this, in improving and expanding the diversity of our team is something that takes a long time, and we have to focus at all levels, in recruiting, retaining, promoting, and making sure that as time goes on, the representation of our firm can improve in this dimension as well. On the right, you see the diversity statistics that we were asked to provide for the underlying fund managers that are represented in the portfolios that are currently Chicago Teachers has exposure to. And you'll see a range, as you might expect, you'll see a range of underlying representation. It's something that within the venture unit industry as a whole, you would see as well. But it's something we monitor. We've seen progress in over time, and something that we do think about very carefully as we're making new commitments. And then lastly, taking it up a level on the next slide to think about ESG more broadly. Obviously, diversity is one piece, but there's a much broader set of considerations around ESG. We just wanted to share a few comments around our firm, how we think about ESG within our venture program. And it's an important piece of how we will go through our diligence process, incorporating thinking about both the risks and the opportunities to generate performance, and how do you measure and think about the opportunity set on both sides of that, right? Because both in the end are important pieces of the investment outcomes, which is what we're set out to deliver. And so an ESG will be pieces of an investment process for every new commitment that we will make within our venture program. And lastly, just at the bottom of the page, in terms of what you have in your versions, we wanted to just highlight some of the initiatives that our underlying fund managers are supporting within various pockets of ESG considerations, whether that be gender and racial diversity, or in other cases, environmental or climate-oriented initiatives. and as an helping to support the broader venture ecosystem in trying to move some of these dimensions forward for themselves, but also for others. With that, let me turn it back to Kirsten, just to go through some of the existing fund commitments.
Okay, so very quickly here, given we're down to 2.5 minutes now. The next table presents the performance of our funds organized from most mature fund to least mature fund. And you'll see the very strong performance of our historical mature funds in their harvest stages. And the less mature funds are maturing in line with our expectations. On the right-hand side, you can see the performance of our funds benchmarked against our peer group. And importantly, they're tracking in the top quartile across each dimension you'd expect. Their multiple, their DPI, which is distributions to paid in capital, and the IRR statistic. The next few slides get into the performance of the underlying commitments you've made to our 11th, 12th, and 13th fund. I think in the interest of time, I'll probably skip over that and just tell you more about our plans for portfolio construction in Fund 14, but I'm certainly glad to answer any questions that you have about the funds during the Q&A period. For Fund 14, our principal mission is to back the set of managers that we think are going to be most likely to be the first call of entrepreneurs when they're thinking about starting a company. And, that mission has led us to partner with groups who have become premier franchise firms today. An important part of the work that we do is also backing a set of emerging managers who we think are well positioned to capture future entrepreneurial talent as well. And, we've included a few examples here. I might mention Construct Capital, which was a more recent commitment that we made during the COVID time period. And it was a woman who had extensive investment experience, having spent time at Northbridge and NEA, partnering with another woman who was part of the C-suite at Uber. And they had a thesis around rebuilding foundational industries and how they could accelerate that with technology applications. And so they're doing a great job and are off to the races, but we're always looking for kind of that next generation of general partners who are going to be the first call of entrepreneurs. So with that, I'll get very quickly into the overview of our Fund 14. As mentioned up front, we are raising a $200 million fund. We've closed on $100 million to date. It's a mix of franchise and emerging managers, 3/4 franchise, 25% emerging. 15 or so manager commitments will be part of the fund, and it's very much an early stage centric strategy with an IT emphasis that will be invested over 2 years. It's not a blind pool at this point with 3 commitments in the fund. And I will leave it there that I think we're an experienced firm that has great access to a set of franchise managers that are well positioned to really accelerate their returns and the strength of the underlying innovation cycle. And we're investing out of a moderate fund size and have taken a consistent approach over time. With that, glad to answer any questions.
Maria? Okay, Maria?
I have a question on page 7. So, I'm looking at each part of this graph. So this is what you're investing in right now, or planning to invest? Because I see number 2, green shades, different shades of green.
Maria, Mike.
Okay, thank you. I don't know who that was that yelled. Oh, okay. Okay, so the different shades of green, it was a little bit more hard. So number 2 would be you're investing, is it 3.6 million or billion?
So that actually represents the AUM of the firm. And so High Vista as a firm has multiple asset classes that we invest in. So we're here just talking about the venture capital piece of that, which represents 2.1 billion of the firm's total 11 billion of AUM.
Okay, I'm sorry, I might have given you the wrong number. I'm looking, number 2 is under private equity. No, is it? No, yeah, private equity is 3.6.
Yes.
So 3.6 in private equity, and number 4 would be 1.2 billion. What do we?
Billion, yep. So
Billion.
these are different strategies that High Vista has, differing products. And so the private equity part of that you're looking at is not a part of the fund that you've invested in historically. That's only the venture capital piece. and it's not a part of the fund that we're here to discuss today. Venture Fund 14 is specifically early stage venture fund commitments.
Okay,
So it's a different part of HiVista, a different team, a different fund.
okay, thank you.
Go ahead, Tim.
So I'm sorry. I know, so you're starting Fund 14, but you're about halfway through Fund 13?
We're about halfway through raising the Fund 14.
Okay.
So we've launched Fund 14 fundraising. We've closed on 100 million from other clients who have decided to invest into Fund 14, our new fund. And then it has a $200 million target. So we have about $100 million more of to reach that target for the new fund.
I think actually to probably look at the page where it mentions how much of your earlier commitment to Fund 13 has been called.
Okay.
And it is about halfway called.
Okay.
The way that our funds are constructed is we commit the capital to a set of managers and then they slowly call that capital over time. And so the managers, we've completed the commitment phase of Fund 13. There's around 15 managers in that fund. They're all actively investing that capital, but they reserve some follow-on capital to support the future endeavors of the entrepreneurs they've backed. And as they're doing that, they'll return to market with new funds. And so we're seeing a lot of the managers that we invest with return to market with new funds. And that's why we've initiated Fund 14's fundraising period.
Yeah, that was my question, because it seems like Fund 13 is not fully realized enough to start something new. So
Yeah.
that was my thought. Okay, thank you.
Yep, sure. It's a good question.
Did you want to go to the page? What page were you looking at? Is that 14 or 10? What page?
Oh.
I think it's page.
And here is, where you got?
On, I'm looking online. It's page
Yeah,
10 for me.
That's
the
10. That was the
HVC
page we were
performance.
looking at. Performance page, page 10.
I think that's what Tammy was just referring to. Too.
Yeah. Yeah.
Go ahead. Yeah.
We were just wanting, kind of an overview because we're seeing, okay, so you harvested. So you got the, monies off of there and you paid your investors, correct?
Yep.
And that's at the rate of, the TVPI. What percent? So it says 21% for, okay, level 2, where you harvested 17% for, return on investment.
Yes, so I can walk through that table in a little bit more detail because I know I was rushing through it in the interest
Okay,
of time.
all right.
So this table is organized, each of our active funds, so funds going back to 2006, the most mature fund is on top. The 3 columns, total value to paid in capital, is a measure of the commitments we've made, the value compared, it's a ratio of their total value to how much has been invested. So Fund 7, for instance, is a 2.7 times multiple of the original commitments. That represents a 17% annualized return IRR.
Okay.
And then of that amount, 2.3, the DPI is the distributed to paid in capital. So how much have we actually physically returned in cash to our investors? And we've returned 2.3 times their original commitments in that 7th fund. So there's still a little bit of value if you look at the difference between the 2.7 and the 2.3. That's why we say it's in harvest phase. Those two numbers are converging over time. If you keep looking down that list, the 8th fund, you know, it's a really incredibly strong performer. It's a blockbuster fund that I love talking about, 5.2 times, and we've returned 4 times investors' commitments. The less mature funds like Fund 10 has just really started to enter into its harvest phase as companies mature and either are acquired or go public. And so we've returned 0.7 times investors' capital, or 70% of their original commitment. Fund 11, which is the first fund that you have committed to, is maturing. It's 5 years old at this point, and you know, early stage companies, when we back them, they're growing, scaling, commercializing, starting to generate revenue. We're starting to see some early exits from that portfolio. And actually, in the news last week, there was rumors that Google was going to acquire a company called Wiz in the security space for $23 billion. That deal was canceled pretty quickly. Wiz decided not to accept the offer, but that would have been a really nice outcome for both Fund 11 and 12. That probably would have been the first distribution from that fund. So we're getting to the point where we will start to see some more liquidity from those funds, but they're generating really nice IRRs. If you look at Fund 11 is a 20% return on the capital that you've invested with us. Fund 12, it's very young. It's only a few years old, early stage, but it's doing what it should be doing at this stage in its maturity.
Thank you.
Of course.
Appreciate that.
Victor, did you have a question?
Yes. Can you describe your investment committee's decision-making process?
Absolutely. So we have a 5-person investment committee, and our job is really to go out hunting for great investment opportunities. So our team spends a lot of time not just waiting for investment opportunities to come across our desk, but trying to go out and network and meet people and make sure that we have our finger on the pulse of what's happening at an industry level. So we're constantly taking calls with new groups and new firms. Our team will write up notes from those, and if it's something that intrigues us, we'll have a follow-up call. As our diligence progresses, we'll then draft an opportunity introduction that will circulate to the investment committee members, which is usually a 2-page document summarizing the firm, the strategy, the pros and cons as we see them, the team, their performance, and any issues that we might want to diligence further. If that work progresses, we have a 2-step approval process such that we go to our investment committee for the first time when we're about 2/3 done our work, allows them to raise any questions that we have, and then return when we've answered those questions to our satisfaction. That's the investment side. There's also a corresponding side where we focus on the legal elements of the partnership documentation, and then the operational due diligence where we dive into just making sure we're aligned with that manager and governance and policy and controls and whatnot. Of course.
So you're here asking about re-up for Fund 14, correct?
Yes.
And I noticed that 75% of that fund is in IT.
Yes.
Do you know, are you involved in data centers or AI for customer service?
We will have some exposure to both of those areas. So our managers are always trying to see what represents a potential next platform shift as we think about technological innovation and shifting to the future. So venture benefited dramatically with the shift from desktop to mobile computing and all the enterprise value that was created on top of that. And I think now we're seeing a real acceleration from a technology perspective, thanks to AI. And so we're seeing a lot of investment in that space.
So the reason I asked that is because data centers actually hurt the environment in terms of water.
Yeah.
Right. They take a huge amount of water.
Yeah.
And AI for customer services actually winds up displacing workers. And there's been studies showing that companies that have brought on AI for customer service have actually a couple of years in decided not to go back to live people because the AI is not working for them.
Right.
So, I mean, I'm a little nervous that 75% of that new fund is actually in IT.
Yeah, so it's various verticals of IT. And I think that part of the technology is actually new energy types and whatnot, whether it's batteries or storage or whatnot. So there's parts of it that are actually helping to propel new energy solutions that are cleaner. As it relates to AI, I think that is one of the concerns related to the technology that people are finding their way through right now is will it result in job loss? But what we've also heard is it's really augmenting skills and capabilities and streamlining some of the more process-oriented tasks associated with customer service and then allowing the customer service agents to actually really engage with the customers in a more meaningful way. And it's not.
That's contrary to all the studies that I've read. So
yeah. Well, we think there are good that's coming out of it, and most of the technology investments that are made tend to be inherently friendly in terms of improving access to different categories, whether it's financial services or access to the internet to allow more people to come online and work online or, connect remotely, et cetera.
Thank you.
Yeah. Sure.
The management fee, 75 BPS, that seems high.
Yeah, so it actually, compared to our peer group, it is in line or probably slightly favorable compared to the peers. Like it is typically in our industry, a lot of our peer firms charge 100 basis points versus our 75.
Thank you so very much, ladies, for your presentation. It's delightful to me as a woman to see an all-woman team presenting. That's very exciting. I want to take a look for me at your diversity profile.
Yeah.
And you started your comments early on in your remarks, calling attention to diversity. So I want to thank you for that, because that clearly means it's something that's important to you. I try to find as many different ways to describe diversity, which is not always in terms of ethnicity or race, but also socioeconomic background and other, things that make us different, right?
Yeah.
But I will say that I found the fact that, if I'm reading this correctly, almost half of the staff are white males, and then another 25% white females. And I'm looking at in the booklet on page 3. And so one of your remarks early on was something along the lines that we're paying attention to it, but it's going to take a while. And so I just want to push back on that a little bit, because certainly a diversification of a workforce is not a new problem or a new issue. And so I'm sometimes bristled by the answer being it's going to take us a while to get there, because certainly we have new pathways available to us, new opportunities that we can hardwire into our own systems where it doesn't take a long time and it doesn't take generations to correct. So I'd like to hear a little bit more about how, what does the next year look like? Say you're in the same situation in front of us a year from now. What steps will you take to present a much different picture to us? And what does it look like now?
Sure. Yeah, I'm happy to. So I will say, we hope not to turn over our employees too quickly. So there is an element of, if you said, what could it look like next year? On the one hand, I hope that we are doing a good job retaining our talent as well. And so there is that time element. I will say, for the way I view it, and this is something that's been very important to me over my tenure at High Vista, is thinking about it as, what is the talent pool coming into the firm when we do have opportunities to fill new roles? There's a question of talent pool getting promoted within, because we do want to retain and keep our talent, and then up to the echelons of our firm leadership. And so just to give you a sense for, maybe it doesn't come through in our numbers, we have, our partnership has expanded in the last year. So we've made a deliberate effort to have a broader base of our firm partnership and our employee ownership. And we're at a 20% representation today. I think over the next year, I don't know if it will be a year or maybe 2 years, we do intend to expand that a bit further. And there are some people in the pipeline that have been very deliberately cultivated as firm leaders who would increase that statistic. But again, I'm not sure exactly the time frame. We have an executive committee that runs the firm day to day. We didn't include that statistic here, but it's, again, recently expanded. It's a 40% representation from diverse and women in terms of the management level of the firm, beyond the broader partnership. That's something that I'm personally very proud of, because I've worked really hard to try and support some of the additions to that team over time. And then within the last year, someone shared with me a statistic. I would have to get the latest, but last year, the 2023 statistic of new people coming into our firm. So again, at differing roles, differing levels, over 70% of our hires last year were either diverse candidates or women or some combination thereof. And again, if I think about where we are today, that number feels very good, because it shows that we are trying to, in a somewhat decentralized way, in terms of the individual roles that are getting filled, trying to really move the needle. So I would hope that we would come back next year and be able to tell you some of those same initiatives in terms of the moving the needle. The last thing I would say is that we've started to engage our employees deliberately in ways that we can engage with our community. So as one example, I've served as an ambassador, which is essentially a mentor figure to women who are trying to get into the investment field in college. It's an organization called Girls Who Invest. And that's a way to try and build the talent pipeline so that when we start getting resumes, we actually have a wider range of people to look at in different backgrounds. And so, on a personal level, we're encouraging our employees to try and do that and showing that from the top of our firm as well.
I appreciate that. And let me give you some thoughts for consideration as you continue to build out.
Yeah.
So you want to think about, I would encourage you to think about, if you're talking about both diverse and women, to bifurcate that. Because all too often, historically, we've seen those two categories confounded in order to sometimes artificially inflate or create a story that does not exactly address people who are furthest from opportunity. So if I put together both race and gender, and I still end up with 25% white women, I'm still looking at a story of people who are farthest from opportunity not being represented in your organization. So I would encourage you to bifurcate those categories. Secondly, I would also encourage you to think about, as you're bringing new people in, let's just say for the sake of conversation that you have an incredibly stable workforce. What will you do, or what other ways will you seek that if everybody wants to stay at your company forever, that you have opportunities for diversity? Because then you would still have the same people that are going to still be there, even though they are, stability speaks to one part of the pie. If you are only seeking different voices by hiring when there's a vacancy, then you still have an issue, right? And then also, as I mentioned before, like creating your own pipelines. So thinking about, we often hear about outreach programs, and I think you kind of alluded to relationships with secondary institutions, mentorship, and oftentimes we find that there's a lot of mentorship, but there's not always a lot of actual promotion, right? So people get guided, but they don't necessarily always get moved, right? And then also just thinking about, I sit and I have the pleasure of sitting with folks who, as you can take a look around, who represent lots of different backgrounds. And so you are talking to a group of people in a city that is already racially polarized in many ways, but also the people that we serve, these fine teachers here and administrators, are serving a community that they would like to see reflected, I believe, in their portfolios. So just think about who your audience is and what you might be able to bring to the table, whether it's us or another, large metropolitan area like Chicago, where those issues are of great concern. Thank you, ladies.
Thank you.
Yeah, your first investment with us was what year?
2019.
I'm sorry?
2019.
2019, okay. What I am looking at, and we had some other presenters earlier this morning and they all gave us the diversity profile for the current year or up till December 2023, but they also gave us their historical data. Is there a page in here with historical data, or all I'm looking at, and I could be wrong, is data that's ending 12/31/23? And if you've been around, 2019, going on 5 years, what is your historical data? Is it in here and I just missed it, or?
No, we haven't included the history. We were guided to just give certain snapshots. We'd be happy to follow up with some additional data if that would be helpful. But I would say, I don't want to speculate offhand about what the data would say historically.
I think part of it is that we were part of Aberdeen's U.S. private markets business. So Chicago Teachers does have the historical profile of our firm at that snapshot in time. But our business was lifted out to become part of High Vista in 2023. And so there would be two sets of historical data, but we can certainly give the High
Maybe
Vista
that's
side of
something
that.
our Chief Investment Officer, Fernando, can make sure that each presenter, has that information. Thank you.
Any more questions? Thank you.
Thank you.
Thank you very much for the opportunity.
Thank you.
So yeah, so the request is to approve 10 million for High Vista Fund 14.
Motion was made and seconded already.
It been motion, so-
Yeah, it was motion, second. Yeah, well,
Yeah, that's-
So if I understood this correctly, we haven't started, or have we started reaping some benefits from this?
No, not yet. We haven't seen money come back yet. So 2018 is getting ready to start, or 2019, that's what they said.
Mhm.
2019 is starting to harvest. They had one that they mentioned, Wiz, which was almost a $23 billion purchase, which would have been a return of Fund 11 and 12. But so far, it's trending in the right direction. IRR is 20% on that first fund.
And which fund did we invest in?
11, 12, and 13.
So we should be, so we should be getting some returns from that. But then they're also or the request is to get more money for the next project.
Yeah, it's actually additional investment, but it's gone down in the size. In 11, we invested 25, 12, we invested 25, 13, we invested 15, and then 10 for 14. So it'll be a total of about 75 million. Venture capital also tends to take a little bit longer to realize because these are early stage growth companies. In the example that they presented with Wiz, it just happens, that's a 4-year-old company that was going to get bought by Google. It's very rare that you have a 4-year-old company that gets a valuation of 23 billion right away. So that would have been a really, really, I don't even characterize it as knock it out of the park. It's like knock it out of 3 parks type of, exit because of the stage that they're at. It's not truly comparable to private equity because private equity, these are mature companies, especially in buyouts. And you could technically buy a company and 6 months later turn it around and sell it to someone else who wants to buy a much improved company. If you're investing in, let's say, an early stage technology that's not yet truly proven out, and the market's not ready yet to see that technology proven out, you may wait a little bit.
And did they say the Wiz decided not to sell or Google pulled out?
Well, what happened was the regulatory environment has become very how do I put it? It's been very difficult with this recent I think FTC regulator. They're scrutinizing a lot of the tech deals. I think another one, there was an Adobe purchase of another very young company called Figma. They're going to pay a lot of money and they pulled it off the shelf because they didn't think that they could get it approved. So the other question that we've asked them is, because the other exit for venture capital is in the IPO market. I think the IPO market is going to start thawing out as the market continues to improve. We've seen companies like Reddit earlier this year come to market. That might open up additional avenues for exits.
Oh, go ahead. I already said.
I think she's reacting to the same thing I'm probably reading.
And trustee Washington.
Well, I was just going to ask if we're, so I saw the recommendation and I guess my question would be, are we being hasty or should we wait longer? Can we get more information, more data?
More information.
A little bit more before making a commitment? That's just my thought.
I totally, do you want to?
Yeah, can I add to your?
Sure, absolutely, yeah.
Yeah, so if I may add a little bit about the overall private. Oh, sorry, is it better? Yeah. So if I can add to what Fernando just said, for the private equity portfolio, we have majority exposure to buyouts in large and small size, and that's about 70 to 80% of the exposure. And then VC is about 20% of the exposure of the overall portfolio. And then we did pacing 50 million per year. And then this is 10 million in 2 years frame. So that will cap the VC. Like if we think about it, we pace at the same pace with the buyout and VC pace at the same pace. And then the exposure should be lower than 20%. So that's like the rough math. And then we have been very careful about, you know, the VC type of risk. So that's for our plan. And then, so we are not doing actual amount of VC.
Yeah, the other thing to add to that, there's a lot of venture capital firms out there, and they're all very small. And so we're doing it in a fund of fund structure with someone who has a lot of experience in it. So it's what I'm trying to get to is to say we found some of the best ones that will allow us exposure to that fund, given that our exposure is only capped at about 20%. We're not going any higher than 20% venture because of the more risky nature of venture capital. But we have firm conviction in Aberdeen, which is now High Vista.
Sure.
Lois Nelson, okay. At any rate, I wanted to go back a little bit to, you said that we started with this company in 2019. So how large, or what is the staff number of this company? Do you know offhand? If you don't, then we'll pass on to
I'll
something
have
else.
I forget.
Was it 73? 73.
Wait, 73? Okay.
I don't have.
Now, all right, so did this company come forth through Callan with the structure that they have in terms of diversity? Because I've been paying close attention, and I'm wondering if they came in 2019, which wasn't that long ago, and we've been talking diversity for years. So why are we still finding companies with no diversity who come in and say, sooner or later, we'll have some?
Yeah.
Okay.
And that's why the other thing we've asked them is to provide data on the underlying managers that they invest in, because ultimately that's part of the economics that it flows to, the underlying managers. And as you can see there's a lot more diversity there. Within the kind of fund investment universe, there's a handful out there that are doing, but not much. I mean, I can think of one, Fairview Capital, that does, that they themselves are minority. But they themselves also won't, they have funds themselves that don't necessarily focus on emerging managers. They try to do the full gamut of venture capital. So it's a mix of both. But, if you'd like in the future, also we could explore a fund of fund manager, a diverse fund of fund manager. But we wanted to bring in, this example who they invest themselves, the money that we give them directly to, a pretty diverse, group of VC. And I don't want to speak out of turn here, but VC is also one of the kind of like last bastions of diversity because, emerging technology, you have to start with Silicon Valley. And if you understand the history of Silicon Valley, it hasn't been very diverse. And it's, and that I think you have every right to challenge, see more, startups and entrepreneurs and dollars going to startups and entrepreneurs who are diverse. That's the only way I think we're going to see eventually manager who themselves will go on to, kind of the big leagues. But right now, I mean, it's I don't want to say slow going, but you've seen, the prototypical stereotype of a Silicon Valley tech entrepreneur.
Is it possible that we could start putting it out there? Like the word is, we're looking for more diversity. And then perhaps we'd see more. Is that a thought right now?
I think our First Friday program, I think, opens up a lot of or invites a lot of submissions. So that's one avenue. But also if we go out there for a new search, that will invite new blood as well.
Thank you.
Mm-hmm.
Thank you. And the magic words were Senate Select hearings. There was monitoring. We made sure that was in place years ago. That's how it started. And miraculously, they would find, and the key word to that is qualified firms. It had to be qualified. And I would use that term all the time. If they said, oh, you're Latino, Hispanic, I said, I want qualified. But because there is no monitoring, everybody's become very lax. They're not worried, oh, they're not going to do anything, you know. So maybe, I don't know what's going on there or what can be done about that. Thank you.
Send the hearings back.
Man, it's been so quiet, 3 years, nothing.
Call for the question.
Any more questions?
Are we still?
No, I'm saying, is there any more questions? It's already second in motion. Okay,
Mhm.
okay. Thank you, Summer. Thank you, Fernando.
Roll call. Trustee Barajas?
Is there a motion on?
There has to be a motion.
Was
No,
to, yes, it was.
So the motion was
Yes, it was.
done before we brought
Beginning.
in the presenters.
Because
I'm sorry.
somebody had
Who made the
requested that
motion?
we
Who
give more
second? I missed
information.
I thought Quentin made the motion and you didn't,
Trustee Benson made the motion.
right, Tammy made it and Baraz, yep.
The original motion.
The original motion was to give them, re-up with them, re-up with them for 10 million, yep.
No,
That's what you requested.
Yeah, I'm not ready.
She was, that's what she was requesting, more
What are
information.
we doing? So.
So we're
we
still
gonna
voting to the
get it
original
more
motion.
information,
Yeah,
wait.
We can take, they can take the,
What-
you
what
can
are we
let
doing?
it fail since the motion is second.
No, she didn't make the most, she
No, we
made,
didn't.
she requested.
So
So you do the roll call, let it fail.
can you let
It's
it,
gonna fail.
Yeah,
and you wanted more information?
I would.
We can't
Mhm.
discuss it, so I understood what we're talking. What the motion's been made and all that, and I kind of want to hear all the rationale and something, but, yeah. Oh, sorry.
More just, it sounds like.
Go ahead, Science.
Yeah, just to repeat, because I know we have, I think if she's still online, but, yeah, I couldn't hear what was being talked about over there, but I kind of want to hear what Paula has to say about them. Yeah, if we're going to call the motion and vote, yeah, I hear what you're saying. That would be my only ask of information that I know of right now from Paula before we vote.
Let me ask,
I think he's talking about at that side, which they can't hear.
yeah,
They are leaning toward needing more information. And, okay, all right, no. Okay.
okay.
Did anybody else say? I heard from that side.
I just procedurally don't know where we are.
Yeah.
So I'm calling for a point of order as to exactly where we are.
There was a dispute over whether or not we had, the motion was made and seconded,
So
but it was
was-
made before they started. So the original motion on the floor is to re-up with them for 10 million.
Okay, Cecilia, who made the motion and who second? What's on your?
Trustee Benson and made the motion and trustee Barajas seconded.
Please just reread the motion because I think there's some lack of clarity on what the motion exactly says. Thank you.
Can I?
And Benson made the motion, seconded by trustee Barajas to approve 10 million re-up to High Vista.
What do you think?
So I was hoping to let Paula elaborate what she's concerned about with this, if that's okay.
Where's Carolyn? Let me ask Carolyn if we procedurally, we can do that because we did start the row.
Yeah, you
If
can have
it's okay to have
discussion.
discussion even though the row started?
You can, if
Okay.
you, that's the chair, if you want to.
Yeah.
I was just making sure we're safe. As long as we're
Yeah.
safe, fine. Go ahead, Paul.
so I think, what trustee Woods was talking to him about, I don't feel like that's going to change. I don't feel like there's going to be a huge change in the data to give us and the historical data that Maria was at. I don't think it's going to be a huge change. And I am worried about our exposure to data centers and AI customer service because I think you were at, staying with me, Victor, where customer service is pushing back on being replaced with AI customer service. That puts us at exposure as a fund because they are starting to fight back and sue companies. Right? I don't want to be involved in that. And the data centers take huge amount of fresh water and use it, which is against our environmental policies. So I just don't want to be a part of that. And like you said, there are other fund to funds. So let's find another one that, in my opinion.
What's the risk if, if this fails and we want more information as far as our concerns.
And Summer, are they at final close at this point?
I think I heard many
Yeah.
Can't hear you. Yeah.
So, yeah, so they just had their first close in April this year, and then they are in active fundraising. By the turn, it should be open for a year to 18 months. I have to check, sorry, to the exactly final close, like when they plan to. So probably if close will be in next year.
So if we wanted more information, we can wait.
I don't think that answers the question,
I
though.
think we got to vote the motion.
But the risk in terms of, was it not getting into this fund or
both.
risk overall?
Both.
So the risk of, I don't think there's so the risk of not getting into this fund is we miss this vintage year in their series. And if it just so happens that they have some really good firms in this pool, we just miss on that return potential. The risk of bypassing and waiting for additional information, very low. I don't think there's any fee discounts at this point, right? So we would just wait because they've got another $100 million to raise. Right. They're trying to get to the 200. So if we wanted to wait and get more information, dig a little bit deeper into either exposure to data centers specifically and AI. So I don't know if they really answer that to say, because I don't know if they really know if they have technology that will displace workers. So we could get more data on that. And I don't know what their exposures to data centers, but in terms of waiting, I don't think that will necessarily hamper us at this point.
And what about the fee structure? You think that waiting will make that more negotiable?
No, not at this rate. I think they're saying 75. Usually when you're getting in the earlier stages, they'll cut you either a first mover or, depending on size, also how much you bring in, you'll get a little bit of a discount. But at this point of their fundraising stage, I don't think there's much of a chance to negotiate that lower.
So they're not.
Right. 50% is raised already.
I also hear about.
We can't hear you.
Oh,
Can she retract it?
is it better now? Yeah. So I also hear concern about the liquidity. So what we can do is that we can provide report updates about our investments, if that's one of the concerns about this fund.
Maria, you had your hand up?
Yeah, thank you. Is there something we can do, and I know I brought it up at the last meeting, and I say it kindly so we can be more efficient. The same format for everyone, same format like this data thing, and all these issues. If we have policies, and as Trustee Barra has it brought up, then I'm assuming you have a checklist. Yes, they qualify. No, they don't. There's a violation of our policies, environmental policies, whatever. And we can expedite things, and then we could make decisions, when it's on the agenda, because the going back and forth, it doesn't sit well, I think, for any of us or them, or people are looking at us and they say, they're going back again, you know what I'm saying. I'll
Sure.
stop there.
Yes.
Thank you.
Go ahead, Victor.
So maybe this is not possible, or maybe this is not going to be the case, but I also don't know if a lot of the players in this area are in the same deal. So we're going to have to choose someone, but yeah, I don't know if there's a way to find this kind of stuff out or not, but it'd be useful. I mean, because if we have to just up with somebody anyway, because they're all playing the same kind of bad game with these kind of centers. So yeah, that's tough to know. So just bringing it up in case that is a factor.
Point of information, or somebody else has their hand up.
Yes, go ahead.
Thank you.
So a couple of comments I wanted to offer for me, for my clarity sake, and maybe it can be illustrative to others. if I'm trying to distill of what's being asked of us, what I think I'm hearing my colleagues say is that there are a couple of reasons why there's some unreadiness. One is that there's a lack of information of what's kind of in this vintage class, in this class right now, and if whether or not we want to basically bet on that horse in that class. And I'm certainly not feeling secure enough to know. I think we all can appreciate the risk that goes along with VC. That's not lost on us. You're taking a bigger risk, but you're hoping for bigger returns. But still within that, I think there's a bubble that we want to operate that makes us feel good about the investment, even if it's a riskier one, whether that be environmental concerns, whether it be displacement of certain workers, whether it be the composition of the management staff itself, right? So I want to start from like, we know it's risky, but then what do we feel comfortable risking our dollars on? And then who do we feel comfortable risking our dollars with? That's, for me, is the hierarchy of needs, if you will. And they're not necessarily in that order because for me, it's just as important to know that we're going to make money, but also that who are we making that money with? So the concerns that I expressed that had to do with diversity are very serious for me. I did not feel comfortable in the answers that were given. And to my colleague to the left, the concerns about how we even being presented information about the tracking over time, the historical data is really important. I would also echo her concerns and request rather for some kind of master table, right? So we have these lovely presentations, lots of trees, but if there were a master table and there was a grid that said, you guys have already vetted these things and there's a check mark or an X that exists so that we look at those 4 or 5 or whatever and know that they've met certain criteria so that when we do look at the presentations and we are hearing from the folks in front of us, we're not just flipping through a slide deck, but we know that they've already met some basic or not met some basic criteria. I think that would be helpful in the decision making and certainly to the chair of this committee, I would think too.
Yeah.
Point taken.
And the OEOC report, how large is their staff? They may say 3%, 20% of these employees are fit in this diversity group. How many do you have? Do you have 50 or 350? Makes a difference. And thank you. You just echoed everything that I said at the investment committee meeting a few weeks ago. That's 2. That's twice. Thank you.
Let me ask before I go to Victor. We started the vote already, so they can't retract their motion.
So I'm not sure we really started the vote because
She just
half the
made
room
a
didn't
statement.
hear the prompt to start a vote. So I think there's room to kind of pull back and say half the room couldn't even hear what was going on. So I think there's still an opportunity to withdraw the motion if that is the
Yeah, that's what I was gonna
way the person who made the motion would like to
Okay,
proceed.
yeah, I just wanted to make sure if we could before, because I thought it started.
I believe you
I want
can.
to hear Victor's comment.
Just quickly, I think Paula, I think the way to look at it is just because they're in call centers doesn't mean that the call center employees are being treated poorly either. So it's more complicated than that. And so we may not get to the bottom of it, but it'd be nice if we could.
What is he talking about? I think that the problem is that it's AI.
So then we were talking about, Paula made a comment about call center employees and stuff. And so, so then what I hear us saying is we want more information and we would like for someone, whoever made the motion, to unmake it. And so.
That's it. She can,
And we need
Yes.
more information.
yeah, or.
We need more
Hold
information.
on, Marie.
Or.
Were you gonna, because we're getting bogged down again. We gotta
I'd like
move.
to rescind the motion.
Okay, what's the procedure for that, Dan, or?
Yeah.
She just retracts the motion?
That's all. Yeah, or may I?
Cool.
Certain deadline.
Yeah, that's what I was asking. So is there's a deadline? Is that gonna come back to us next month or?
Yeah, we'll bring
Deadline
it
to
back
get
to
the-
the next board meeting. There won't be enough time for the August IC meeting, but we'll bring it back with more and deeper information. So addressing everyone's points.
Okay. Marie, we gotta move on because we're like 20 minutes behind.
No, I was just gonna say, she could
I'll
have withdrawn
work, yeah.
or we could have voted it down. There was another option.
Well, that's what I
No,
was
I know
asking
she
for
did.
clarity
Thank
on,
you.
Just clean.
because I thought that we started voting, but Carolyn said that we
Yeah,
didn't.
I mean,
'cause
and that's always
half the
another
room didn't
option
hear, so.
too.
No
But
problem.
this-
Thank you.
I think this provides more flexibility in terms of next steps than to vote it down.
Okay, so that takes us,
Thank you.
thank you, to eight A, the vote agenda. 8A, approval of the minutes for the special meeting on May 21st, 2024. I'd like to entertain a motion for approval of the minutes for a special meeting on May 21st, 2024.
Move.
Is there a second?
Second.
Motion was made by trustee Washington, second by trustee Vincent.
Trustee Barajas,
We're at 8A, approval of the minutes for May 21st.
Trustee Barajas,
Yes.
Trustee Beza, Trustee Blackwell,
Yes.
Trustee Nelson,
Yes.
Trustee Ochoa,
Yes.
Trustee Price Ward,
Yes.
Trustee Riley,
Yes.
Trustee Rodriguez,
No.
Trustee Benson,
Yes.
Trustee Washington,
Yes.
Trustee Woods,
Yes.
ten ayes, one nay.
Thank you. B, approval of the minutes of the regular board meeting on June 20, 2024. I'd like to entertain a motion for approval of the minutes of the regular board meeting on June 20th,
So
2024.
moved.
Second.
Made by trustee
I have
Rodriguez,
a
second, and seconded by trustee Washington. Right, what was that? I'm sorry.
It was Rodriguez.
Who made the motion?
Woods.
Trustee Woods.
Oh, Tanya, you made them. I'm sorry.
Trustee Woods made. Move the motion.
And it was seconded by Washington.
Mm-hmm.
Yes.
Yes, and I had a question. The minutes to our Attorney Clifford, the regular board meeting, that did not include, does that include the executive session minutes that needed some tweaking?
Separate.
Separate.
That would be separate. And you're talking from the same date?
Pardon?
Are you talking about from the same date?
That's what I'm asking you. I don't remember what the date was. Remember, because you took notes about attendance. So are those, is that separate from the?
It is separate.
It's
That's separate.
Okay, thank you. Thank you, President Blackwell.
You can call the question.
Trustee Barajas,
Yes.
Trustee Beza,
Yes.
Trustee Blackwell,
Yes.
Trustee Nelson,
Yes.
Trustee Ochoa,
Yes.
Trustee Price Ward,
Yes.
Trustee Riley,
Yes.
Trustee Rodriguez,
No.
Trustee Benson,
Yes.
Trustee Washington,
Yes.
Trustee Woods,
Yes.
10 ayes, 1 nay.
Thank you. C, approval of staff dental provider, Blue Cross Blue Shield of Illinois. I'd like to entertain a motion for approval of the staff dental provider for Blue Cross Blue Shield of Illinois.
So move.
Second.
Motion made by trustee Price Ward and
Discussion. You're taking.
who made the second?
I did.
Okay. Price Ward made the motion, Washington seconded. And
Discussion?
It's that presentation.
it's presentation.
It's a presentation and then questions. Okay. Yeah.
You'll pull up the presentation first. That's the actual board action report. Thank you.
All right, so, Siegel assisted the fund in conducting a, request for proposal bid for the staff dental plan. And we sent out, an open bid for anyone that wanted to bid, and we ended up getting, 7 bidders here. But only 2 of the bids were financially viable. 2 ended up declining the quote. They decided that they didn't after they originally said they wanted to bid. And then a couple were just way more expensive. And then one just didn't have any good rate guarantees. So we ended up, if we go to page 4, with Blue Cross Blue Shield of Illinois and United Healthcare being the 2 that were in the running for finalists.
You can see that the dollar amount is very close. They're both $147,000. They're both lower than what the current amount of $150,000 was in total premium. Blue Cross is the incumbent. If we go to page 5, we can see that Blue Cross had a rate guarantee of 2 years plus another third year with a 6% cap. UHC had 2 years with no cap on the third year. On page 6, you can see that access for both networks is very good. So that wasn't an issue. Network penetration, it wasn't an issue. Of course, if you move from Blue Cross, there would be a little bit of employee disruption because some people might have to change dentists. But again, the financial difference wasn't very much either way between the two groups. So with that, I think it's, you're going to go through the bar.
So based on the scoring criteria, the 3-year premium cap, and having a single plan administrator, Blue Cross and Blue Shield PPO service, the recommendation is that Blue Cross and Blue Shield PPO service for 2025 plan year effective January 1st of 2025.
I think Lois was first.
Oh.
You had to come?
My question is regarding the presentation. Now, the Board of Education uses a different dental plan. So was this plan comparable to what the teachers get with the Board of Education? And the reason I ask that is because unfortunately I was unable to attend this particular meeting. So if you can give me some reference right now, I would appreciate it.
So to be completely transparent, what we did is we matched the current dental plan that was in place for the staff.
Okay, the staff in reference to what the teachers get?
No, the staff in
The
reference to the
actual
fund
teachers.
staff, the fund staff.
No, I know, but what I'm concerned about is that the teachers pay for everything that we do here at the fund, because this is a private entity. It's not a big company. So I would assume personally that we would see what the reference is to what the teachers are given in the schools as to reference to what the staff is given. And I'm very sorry that I was not able, to attend that particular meeting.
It didn't come out that.
Oh, it didn't? It should have. What I'm saying is we should be, and I believe that the teachers who are here are hearing what I'm saying, is that we have to keep in mind that this is a private entity, the Chicago's Teachers Pension Fund. So we should always keep in mind as reference to what the teachers in the schools are doing in terms of what is happening here at the fund. Am I correct in this?
And Trustee Nelson, just to be clear, what I'm saying is that it wasn't on the agenda, not that we shouldn't have that discussion.
Okay.
Yeah.
Gotcha.
Okay. Quinn, let me go to Maria. She had a. Did you have a comment? Yeah. Oh, okay, go ahead.
So just for clarity, so that I think we're all clear, so CPS generally pays for the dental. Am I correct in that? They pay our dental for the teachers and staff. It's through Delta Dental, and we pay a very small portion if you want the PPO, which isn't that great. So,
Can I interject with you? Just a
Sure.
little bit. Is that the Delta Dental does not cover a lot. So I would like to know versus, because I'm here as a teacher, and so I'm assuming that the staff given what the teachers in the schools are given, that it should be commensurate of one another. So I want to know, Blue Cross and Blue Shield is normally much higher than Delta Dental.
Yeah,
Yeah, but I would like to add, in this case, it wasn't.
Right.
Delta Dental was
So
more than
then
Blue
just
Cross.
tell me, thank you. And see, that's
Yeah.
what I'm saying. Let's be transparent here.
Yeah.
Yeah.
So yeah, they were more expensive, and as far as based off of what the finalists were, Blue Cross Blue Shield seems to be the best. Now, it doesn't appear to be the cheapest. It's not the cheapest, but it's the better of when you look at the whole cost over the cost of 3 years, it still lands cheaper and it's what they currently have. So it keeps the staff from having to have all that disruption and stuff. So from that perspective, I think this is the best route to go. And I mean, fortunately, the pension fund staff is way smaller than Chicago Public Schools. So the cost would be way different anyway. But I personally think that if we can give the staff if we can get the biggest bang for our buck to make sure that the staff got good teeth and all that stuff, then I think we need to do just that. And maybe, no shade to, no shade to CPS, but maybe they can take a page out of this book to do better for us as employees, because it appears to be a better plan than what we got at CPS as active teachers. Now, for you retirees, I don't know what y'all dental stuff look like.
We pay
And so,
for it, okay? We all pay for it as retirees. That's another story. And I'm not getting into that, into the intricacies of that. But I just wanted to make sure that the teachers who are working every day and who supply the money to the fund feel comfortable knowing that we're on equal plane. Or they're on equal plane. I'm just here to look out for them. Okay.
I get it.
Any more questions? Thank you. Call the question.
Trustee Barajas?
Yes.
Trustee Beza?
Yes.
Trustee Blackwell?
Yes.
Trustee Nelson?
I'm kind of in between because I don't know much. So can I abstain at this point since I don't know much? Okay, thank you.
Trustee Ochoa?
Yes.
Trustee Price Ward?
Yes.
Trustee Riley?
Yes.
Trustee Rodriguez?
Not at this time.
Trustee Benson?
Yes.
Trustee Washington?
yes.
Trustee Woods?
Yes.
9 ayes, 1 nay, 1 abstention.
Thank you. Okay, thank you. D, approval of Health Insurance Committee recommendation for renewal for 2025. I'd entertain a motion for approval of the Health Insurance Committee or the chair.
So moved.
Second.
Trustee Riley, seconded by Trustee Washington. Hello, Gary.
Good afternoon. How are you guys all?
Good. Yourself?
Good, good. So I'll just jump in because I know you guys are tight on time.
Need the board action.
Thank you.
You can't hear that.
They can't hear?
Oh, there we go.
Put it closer. I can do that.
D.
How about that? Is that too loud?
No.
Okay, very good. All right. So you'll see the board action is up there. The pension code limits the amount that we defray members' health insurance costs to 65 million annually, plus a carryover of the previous years. At the end of fiscal year 2024, the carryover of the health insurance spend was estimated to be 63.6 mil, and the estimated expenses were 67.7 million. Based on these results, the staff is recommending that the board authorize 60% subsidy for the calendar year 25. Forecasting forward, CTPF may have to consider lowering the subsidy in subsequent years, with the market trends showing that health insurance expenses are increasing overall based on several different factors, including the Inflation Reduction Act, utilization of brand and specialty meds, and inflation. The statutory allocation for the health insurance is 65 million since 2004. CTPF has worked diligently to sustain a high quality, low cost coverage and keep the cost increases below industry trend for the last 20 years. Current forecasting models show that we can expect increased expenses in fiscal year 25 and beyond, and the current subsidy percentage is not sustainable in future years unless CTPF can secure additional increase in the $65 million statutory allocation. We will be working with Siegel as well as the lobbyists in the upcoming months. And you can probably scroll down. If we can't secure increased funding next year, we will have to consider several different options, including looking at lowering the subsidy, possibly adding a deductible for brand meds, or adopting a formulary change. But as we look at the premiums as promised for the calendar year 2025, the premiums are stated in the bar. As mentioned during the Health Insurance Committee meeting, the Humana rate did come in at $143.90, which is at about a 10% increase. Initially, we thought it would be 11.3%. With that, I will say that the recommendation based on the analysis and projections, the Health Insurance Committee recommends continuing the subsidy of the annuitant health insurance cost at 60% and approving the renewal rates for the calendar year 2025. Staff will continue to do their due diligence and reevaluate the reserve and subsidy levels on at least an annual basis. Thank you.
Maria?
It was a great report, but on the agenda, it says page 203, and it's not on page 203. 203 is a new renewal information. So in the future, if you can do that, because I wanted to follow with you while you were reading everything. And I think it's on what, page 221?
Yeah, Trustee Rodriguez, that's the start of the health insurance information is on 203, which starts with the presentation.
Right, but it doesn't say that on you. Look at the agenda, what it says. 220, yeah, but read your agenda. I'm looking at it with 4 eyes right now.
I mean, what's,
That's how it always works.
I'm sorry,
that's what I thought. So,
it said 203.
I don't know.
I don't think 221.
Thank you all. You can call the question.
Trustee Barajas?
Yes.
Trustee Beza?
Yes.
Trustee Blackwell?
Yes.
Trustee Nelson?
Yes.
Trustee Ochoa?
Yes.
Trustee Price Ward?
Yes.
Trustee Riley?
Yes.
Trustee Rodriguez?
I would not opportunity to ask my question. My question is it all or nothing at all?
Middle of the vote now.
I know, but okay.
I didn't know you had a question. I thought you just.
No, because you pulled it right away when I said, that it wasn't on that page. Carrie,
You
is
never
it
said that you had a
vote
question.
all of it?
Maria, we have to move on because we
No,
saw,
I know that, but remember the presenter went over 15 minutes?
but I'm saying you didn't
Yeah. No,
voice a question.
I did. I
You
had my
just-
hand up. Okay, so is it an all?
Maria,
Executive Director.
Maria,
Mhm.
we're in the middle of the vote. So we get to move on. Thank you.
Clarification of what she's voting on.
I know that she had a question. I thought she was
But you
just
do now.
disputing,
Thank you.
but we already started the votes.
Mayor,
Yes.
the question is, what is the vote on? So she's asking for clarification of the actual, what we're voting on, not a commentary or a question about the content. So if the vote is the vote to accept the
The
entirety,
recommendation.
the entirety of the report? Okay.
Go ahead, Victor.
Action request, what we're voting on.
Yeah, that's what we're voting on.
Yeah, I know that, but, okay, Victor, I'm sorry you didn't understand the question. At this time, no.
Okay. I'm sorry, Cecilia, where were you in the vote?
Okay,
Trustee
make it a yes
Benson?
then. Make it a yes. Just. I'll explain the membership when they ask me. Thank you.
Trustee Benson?
Yes.
Trustee Washington?
Yes.
Trustee Woods?
Yes.
11 eyes.
Is there room for discussion?
Council?
It's the chair's pleasure if you want to entertain that discussion.
Go ahead, Tanya. You had a point.
Yes, so I think my I guess observation or question, if there is room for clarification on the substance, the underlying substance of that we just take a moment to clarify that, just so we're clear.
I think that's always wise, just to
Yes.
facilitate moving forward as opposed to having someone not understand what's going on.
Could you do that for us, Executive Director or President
Sure.
Blackwell?
I mean, I didn't have a problem with anyone receiving clarity, but there was no question posed. She just stated that there was a discrepancy in the page numbers and she wasn't able to follow along with the presentation. She never made a comment for a question. So I said, call the question.
But it was.
We're going to beat a dead horse now, then we're going to get
It
bogged
was
down a little bit
beyond that.
longer.
It was, you're the parliamentarian, and that's one of the questions,
You
first
weren't-
question I asked before.
You weren't
we-
provided the
So I
floor,
think-
Maria.
I think what we're clarifying is going forward is always helpful if you lead with what it is you need to participate in the vote. And then if you have concerns, for example, that the materials weren't put together well, it'd probably be a side conversation with staff. But also to Trustee Wood's point, the chair should always be sensitive to understand what it is that a trustee needs to participate in the vote.
I've been on this board for 17 years. I know the policy, but it changes for certain trustees. That's okay. Thank you.
My last question, if
Go
you
ahead,
don't
Tony.
mind. Thank you. The document is long, it is voluminous. The Bates numbering does leave room sometimes for changes in the future for recommendation. If on the agenda, the references to the section in the presentation, perhaps that can be clarified so that it does not necessarily point to one single page. So in the future, if the Bates numbering changes or we get an additional proposal, it doesn't mess up it doesn't ruin the record, if you will, on the agenda. So if the agenda refers to the section, then it refers to the section.
Not the issue here. All of the agenda items give you the page number for where that particular item starts.
That's my point. Thank you.
Thank you, Carrie. And Jen. That takes us to E, approval of updates to overpayment recoupment. I'd like to entertain a motion for approval of updates to overpayment recoupment. Someone?
So moved.
Thank you.
Second.
Motion made by trustee Vincent, seconded by trustee Price Ward.
Hello.
Hey, Jen.
Hello.
I will try to make this brief and leave, if there are questions, we'll talk about them. I'm going to go through 3 policy updates, but essentially the gist of the situation is that over time, legislation changes. We've had legislation, the Internal Revenue Code has been updated, and we recently heard of the passing of the Secure Act. And so then we have to go back to our policies and just make sure that they align. And there was also legislation, as we've talked about in the past couple of meetings, to update the return to work policies. So our intent here overall is just to bring our policies in line with what is current as far as federal and state legislation. So the first one is the board action request related to the overpayment recoupment policy. And I'm going to summarize the changes.
And you are on page number.
I don't have page numbers in front of me for my. It's the first board action request for the overpayment recoupment policy is what I'm looking at.
238. Yeah. Thank you.
Okay. So I'm going to summarize what those changes are. You have a redlined and a clean version. We're bringing the write-off amount into compliance with the current guidance. So currently the write-off amount where we can forgive an overpayment is set to $100. We are recommending an increase to $250. Reducing the recoupment of and hardship percentage for overpayments after death and other overpayments. So currently, the fund can recoup up to 25%. The recommendation is to reduce that to 10% and bring down the hardship from 10 to 5%. Setting a de minimis amount for benefit changes. So if we have to do a revision to someone's benefit because of a small adjustment is typically what the situation is, and it results in a change of less than $10, we are suggesting that we move forward with that change. We don't charge interest, and we just do it on a go-forward basis. And then the other change to this policy is that within the policy, we used to show the underpayment policy inside the overpayment policy. And so when the executive director and I were reviewing the policy, we thought it made more sense to bring it out and make it its own policy. It's related to underpayments, not overpayments. So in summary, those are the recommendations for this policy update.
Go ahead.
Could you tell me what page number are the red line sections? Because that's not what, you know that. This is what you gave me. That's not the.
Trustee, oh, I'm going to answer that question.
Oh, go ahead.
And you're right, they don't have page numbers.
Attorney Clifford handed that one.
You have the page
This is
numbers,
something
trustee
that-
Rodriguez? Page numbers starting 223 for the red lines.
What she just talked about is 227,
Oh.
227 and 228.
Right.
Mhm.
My question was about, I want to say the overpayments.
That's what,
So with the overpayment, this is in the event that someone passes.
that is one section of this policy. So the overpayment policy takes care of a few different scenarios, but that is one.
Right. So overpayment, if someone passes and the money is put in their account and is pulled back out?
No.
No, that's something separate, right?
That, yeah, so I think what you're talking about is overpayments after death, and that is
Right.
in this policy. And what this specific change relates to is if there's a surviving spouse,
Got it.
instead of, if the surviving spouse received, say, a few months extra, right? And then we're going to pay the surviving spouse, we offset future benefits, right,
Right.
accordingly. And instead of taking 25% of their benefit, we can lower it to 10.
Got it. The other one that I had a question about was, it was with the overpayments. Actually, it was with, never mind. Go ahead. I got it.
Right here.
I got it.
225.
Because, well, yeah, I'm looking at this, but my question is on the other one, so never mind. Go for it.
Maria?
So my question is, what we do see, when there are overpayments and somebody, as you say, the person we just. I'm sorry, and we discovered there were people, there were members, annuitants who were deceased for 10 years and some more than 10 years, and we were still sending out that monthly benefit. So it was something on our end that nobody was monitoring, or apparently, I don't see how anybody could be deceased for 10 years and their family members still getting that benefit. So we're reducing it. At some point, it was said several years back that anybody who continues, and they knew that person was deceased and they kept on getting that check. And we know some of the people, some of trustees who agree with that. We said those usually at some point, sometimes there were criminal charges brought against those people. I don't know what the current status is on that or not, because they were still catching the checks and they knew their mother, their father, grandfather was deceased. So what is the purpose? I'm trying to understand, and it sounds good. I mean, you're going from 25 to 10%, but that's almost rewarding somebody because they were cashing checks illegally. So what is, if you could explain to me, and I'm sure there must be a rationale, I just want to understand it.
This is, I think this is a different scenario.
It's a different one?
Yeah,
Oh,
it's-
not a death overpayment, not a death overpayment.
It could be a death overpayment, but you're not, the situation we're talking about is when a surviving spouse is getting set up. It's not a nephew, right? Or somebody who's not related. It's that there is money owed to a surviving
Oh, okay,
spouse, right? And usually it's not 10 years of payments. They've received maybe a couple of months and they forgot to notify us or took us a little bit of time for our vendor to report it.
Perfect. Thank you for the explanation. Got it.
More questions?
And then, so there were two, you were covering that one, that was not the death overpayment.
Maria Victor's up next.
Or does it say on here?
So I'm just listening to you talk about it. This is just making things fair, is what I am hearing you say. That some of this was overly burdensome in the past, the penalties. So now we've made it fair. And
I-
it's
It's just bringing it bringing it in line with the current legislation. Essentially, we were in the past following how the law looked at overpayments, and it's softened. And so the policy will go according to what the, sort of what the government and state feel about recoupment.
And in my reading of it, and I think you're agreeing, is all of those changes are now to be less punitive because it wasn't intentional one way or the other, whether we overpaid, underpaid, they didn't notify us. These make things reasonable is what I've interpreted as that. Is that, would you agree?
Yeah, I would say less punitive to the recipient. Yes.
Thank you.
Last comment, then we got to move on, Maria.
Yeah, so Jen, so on page 220, overpayments after death. I know I suggested something municipal fund does, that they do a proof of life once a year, and it was shot down. Is there any chance we can do that? Because I know recipients who are part of the municipal fund, PSRP, people who were never teachers at the Board of Ed administrators. And every year they have to fill out paperwork. During the pandemic, I think it stopped or it paused for a while to say, this is me, here's my proof of life, I'm here, so that we cover our bases and they're not receiving money that they shouldn't. If they've transitioned, they've transitioned.
Sure. You want me to take this? Or-
Well, the
okay.
question-
Well, we are monitoring our death overpayments carefully. So we haven't gone down the road of a written proof of life mailing at this point. But that is because we're using a variety of vendors, and we're actually evaluating other vendors to do it more with technology. Because as you might imagine, we have 28,000 almost payees, right? So what's the most efficient way, as long as we're not missing people, of making that happen? And we are using technology and monitoring. We're looking at anybody who ends up overpaid to ensure it's just a short time or it's not happening at all. So we are carefully monitoring, meeting with the executive director and legal on at least a quarterly basis, going over this. And so we will consider that if we feel like our current methods aren't meeting, but we do feel like our current methods are meeting that criteria at this point.
Thank you.
Quinn.
Right, that's okay. That's what I was going to ask. Is if that's even warranted to have to go down that rabbit hole right now, but you answered the question. If we're monitoring and knowing that we don't have hundreds of people that's getting overpaid, then that I think would be sufficient, but yeah, so I'm good.
Oh, Mary
My
Sharon.
hand is up.
Go ahead, Mary Sharon.
Yeah, this was happening years ago before we had access to Nexus to be able to determine people had died. And they're survivors, children or whoever, and they had over $500,000 they kept, and they thought that it was theirs. So we're doing a much better job now.
Thank you. Call the question. Thank you.
Trustee Barajas,
Yes.
trustee Beza,
Yes.
trustee Blackwell,
Yes.
trustee Nelson,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Riley,
Yes.
trustee Rodriguez,
Yes.
trustee Benson,
Yes.
trustee Washington,
Yes.
trustee Woods,
Yes.
11 ayes.
I can't see. Return to work is next, correct? Is that the next on the agenda?
You have underpayment.
I have
Yes,
underpayment next?
underpayment.
Okay. I'm sorry, I can't
Yeah,
see the
let-
agenda.
Let me get the motion out there. Proof of standalone underpayment policy. I can entertain a motion for that.
So move.
Second.
Motion. Motion, trustee Washington and trustee Riley.
Okay, very quickly, as I mentioned, this is just a new policy. The language was in our overpayment policy. All we are doing is removing it and putting it in a standalone policy so that it makes more sense.
Okay.
I'm sorry, could you elaborate a little more that makes sense so I have a clear understanding?
Because if, from our perspective, if a member was underpaid and they wanted to see what our policy was on it, it wouldn't be intuitive to look at the overpayment policy, right? To try to figure out what happens if you're underpaid. So we just thought it made sense to keep it as its own policy so it was easy for people to access and understand.
Thank you.
Call the question.
Trustee Barajas?
Yes.
Trustee Beza?
Yes.
Trustee Blackwell?
Yes.
Trustee Nelson?
Yes.
Trustee Ochoa?
Yes.
Trustee Price Ward?
Yes.
Trustee Riley?
Yes.
Trustee Rodriguez?
Yes.
Trustee Benson?
Yes.
Trustee Washington?
Yes.
Trustee Woods?
Yes.
11 ayes.
Thank you. Takes us to G, approval of updates to return to work policy. I'd like to entertain a motion for approval of updates to return to work policy.
So move.
Second.
Sorry.
Yeah, I was gonna say,
Making that.
Lois, could you make it? Trustee Nelson made a motion, and second by Trustee Washington.
Yeah, I guess at home you don't get to do it.
I'm sorry, Mary Sharon, I didn't look at the screen. My apologies.
That's all right. I don't think I want to
Okay,
be involved with return to work anyway.
All right, so I'll really quickly. So two of our exceptions for working teachers were extended. They were set to expire June 30th, 2024. The governor signed the legislation extending them to 2027. One is subject shortage area. So teachers working in a subject shortage area will not have their pensions canceled. The next is changing the days that you can work in a temporary position from 120 to 140, same time frame, now extended to June 30th, 2027. The compensation limit no longer applies. That was already in the legislation. We just wanted the policy to be super clear on it. And the last thing is the same reduction in penalty if we take deductions, instead of taking 15% reduction, we're going to lower it to 10 to be in line with the other overpayment policies and the hardship to 5. So it's the same exact thing we just talked about before. So those are the changes to the policy.
Call the court.
Trustee Barajas?
Yes.
Trustee Beza?
Yes.
Trustee Blackwell?
Yes.
Trustee Nelson?
Yes.
Trustee Ochoa?
Yes.
Trustee Price Ward?
Yes.
Trustee Riley?
Yes.
Trustee Rodriguez?
Yes.
Trustee Benson?
Yes.
Trustee Washington?
Yes.
Trustee Woods?
Yes.
11 ayes.
Thank you very much.
Thank you, Jen. Thank you, Becky. Where's H? Approval to issue Security Operations Center. I'd like to entertain a motion for approval to issue Security Operations Center Services, RFP. Victor, you want to make that motion?
Microphone. Just to summarize, I mean, we've been using these guys, if I remember correctly, and we're just going to re-up. So it's not that complicated, but it's extremely necessary. So I can read it, the fund. Well, no, I'll pass it on to you.
Yeah, the request is to approve posting an RFP to solicit bids for security operations center services. That includes monitoring of the fund's computer networks and event logging and managed detection and response and vulnerability management. So we just want to make sure that we're getting good good value for the money, and we're choosing the best vendor for the fund. So it needs to be, this is not simply a renewal of the existing contract, but we're opening it up to all vendors to submit bids.
Yeah, so I messed up when I was saying re-up. It's, yeah, we're looking out there, see what is there, and maybe better price and service.
Yeah, and there have been a lot of changes in the technology since 2019. So it's time to revisit this.
Yeah.
Did you want to make the motion, Victor? Did you? I think you didn't make the motion. You started talking before.
Yeah.
So moved. Yeah, you made.
If he made the motion, I don't know if you want to
We
make it.
All right.
did.
And then there's second.
Second.
Okay, motion was made by trustee Ochoa, seconded by trustee Vincent. Mary Sharon, was your hand up?
No, that was a mistake.
Oh, okay. I'm just making sure.
Thank you.
Yes.
Yeah, that's what I was going to say. I thought we had paid a lot of money through IT department to get this done before. What are we currently paying?
So the cost for the annual cost for the contract with the current vendor Rapid7 is a little over 250,000 a year.
Okay. Have we had any problems with them at all? Because
No issues or problems with the vendor, but we want to ensure that we're getting good value for our money.
no, I'm
and-
fine. Yeah, I'm fine with it. We should do RFPs
Yeah,
regularly.
yeah, and Rapid7 has expressed an interest already in submitting a new proposal.
How do they know?
When
Who does?
when
Oh,
the
same-
RFP is when the RFP is posted.
So the same company's going to reply to the RFP? Is that what you're saying? Or
Yes, they've already indicated their intention to submit a bid.
Thank you.
Go ahead. Go ahead, Lois.
Would you give us the cost of this RFP right now? The cost to put it out there?
Well, it's budgeted as an FY 2025 expense. It's in the budget. It's
Can you give us? the
between
cost?
250 and 275K.
That's just to put it out there.
No.
There's no cost.
No.
I'm not sure that there's no cost to posting the RFP.
Okay, if you're using a company to post the RFP.
We're not.
Okay, so you're saying that, okay,
It'll be posted on the website and
okay, and then you're thinking that it's 250 to 275 to actually.
yeah,
Have it.
that's what's been budgeted for it.
Call the question. Thank you. Dan.
Trustee Barajas,
Yes.
trustee Beza,
Yes.
trustee Blackwell,
Yes.
trustee Nelson,
Abstain.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Riley,
Yes.
trustee Rodriguez,
Yes.
trustee Benson,
Yes.
trustee Washington,
Yes.
trustee Woods,
Yes.
ayes, 1 nay.
Thank you, Dan. That takes us to I, approval of trustee training hours. Do we have any trustee training hours that need to be approved? Miguel.
Good afternoon, trustees. Thank you again for everything. Much appreciated.
October 5th, 9th.
So we're asking for approval of the trustee training hours as presented.
Is there a motion?
So moved.
Motion made by trustee. Trustee Price Ward made the motion. I don't know who seconded. Vincent? Okay. Call the question. I already called the question.
I know, but you didn't acknowledge, you didn't look around, see if the rest.
Go ahead, Cecilia.
Okay, please make note of that.
Trustee Barajas,
Yes.
trustee Beza,
Yes.
trustee Blackwell,
Yes.
trustee Nelson,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Riley,
Yes.
trustee Rodriguez,
No.
trustee Benson,
Yes.
trustee Washington,
Yes.
trustee Woods.
Yes.
Thank you.
Thank you,
10
Gail.
ayes, 1 nay.
We're like an hour and 2 minutes behind. Yeah. Okay, that takes us to, yeah, we still got a
Attorney Clifford.
session. This is,
You assist in directing, check whose hands up.
oh,
That's not
later. Conference, is that, yeah, that's.
Separated, so.
Yeah,
Oh.
so we're at 9, report of the executive director.
Okay. That's how I was looking at it. I felt it was your time.
All right, so we're going to bring up the slide for the strategic plan update from 2024. Thank you, Mr. President, members of the board. Our report for this month is the strategic plan update and then our normal update on contributions and staff activities. As you'll recall, the strategic plan was adopted by this board in June of 2022. And since that time, the senior leadership team has moved that plan from a conceptual document to a living, breathing, working roadmap that's allowed us to accelerate our progress toward our goals. 2024 has not been any exception to that. The year concluded with another tremendous year of progress, with all of our attainable goals for the year of 2024 achieved. Our work in 2024 has focused on, obviously, the launch of our pension administration system and executing the process which will lead to that system implementation. In fact, many of the tasks in that 2024 strategic plan included items to move that forward, and we're making great progress. Other accomplishments during 2024 include our investment team's execution on the asset liability study and the asset allocation policy, which you're seeing with the various asset classes that are coming before the board for approval as we shift to the new asset allocation policy and the restructuring of several of our asset classes, all with the goal of increasing our investment returns. The IT department officially added 2 new leaders, and we continue to prioritize cybersecurity and system modernization. We set an example in transparency and governance for public plans around the country with our live streamed meetings, which debuted in January of 2024. We improved in our training for the member services team, as well as increased the accountability with our new call feedback system, which have led to increased satisfaction with our call center. Changes to employer services processes have led to increased payroll audits. Our goals for this last year was 19 audits, and I believe we completed 50. The organization continues to receive benefits from our internal audit function that's matured and really serves now as a source of improvement for the organization. We received Great Place to Work status for the 2nd year in a row, and we achieved that with a substantial increase in scores for the organization. And our leadership team meets every month, but we met to review the progress on our strategic plan in July. We added several goals to mitigate risk, as well as to improve the organization based on the feedback that we received from the staff survey. So as you can see, the strategic plan continues to be a living document, but you see our report card here at the bottom of the screen. 100% of our goals completed, which included 212 sub-strategies. Comparing that by year, in 2023, the first year of our strategic plan, we completed 121 of those strategies, and in 2024, 212 were completed. Looking forward in 2025, we have 81 planned as of now, and the main goals for 2026 and 2027 are around the final pieces for implementation of our new system. So making great progress, and all of this are grouped with our organization alignment tied to our mission. The 4 core areas: providing for and enhancing the economic well-being for our members, ensuring efficient and effective management, earning and keeping our stakeholder respect, And then, of course, ensuring compliance with applicable laws and standards. Under those categories, just some highlights from 2024. We talked about it earlier, but we provided this vehicle for feedback for use by our call center. That was one of the things that we've been working on for several years so that we could actually hear back from our members in terms of how we're doing when they call our call center. So more to come on that. In fact, we're having a meeting on Friday with the initial returns from that implementation. Under ensuring efficient and effective management, one of the things that we completed that was big for us this year was an organizational restructure to make us more aligned with our strategic plan so that we could accomplish our mission. Under earning and keeping stakeholder respect, we've improved the relationship with the Board of Education and CPS, and we're seeing some of the fruits of that with the recent change of stature or stand from CPS in terms of assisting us with charter schools that are deficient in their payments. And then finally, under ensuring compliance with applicable laws and standards, we are starting to explore options for referring overpayments to the Attorney General, and that is starting to happen. So several things are moving, and then looking forward for 2025 and beyond, we're focusing on receiving 100% funding for the plan, addressing the Tier 2 safe harbor issues, making sure that our pension fund has a strong succession plan in place, and that we implement an enterprise-wide risk management system. So moving to the next part of my report, which relates to our contribution summary for this last period. We are still in the process of collecting our 2024 contributions. The required contribution for 2024, fiscal year 2024, was just over $1 billion. And as of this report, we had $151.5 million to collect. But as of last Friday, more dollars have come in, almost 90 million came in, and now we had 65.8 million to collect to finish off 2024. Some of the activities during this last month I want to highlight. Birthday cards from CTPF. We continue to send those to our members turning 90, those turning 100 and 100 plus. So we did that in July and August. We talked about our budget at the last board meeting. That process is complete. It was approved at the June meeting. And now our finance department is working on implementing and training members on 2 new systems, our MARTIS system for budgeting, as well as our Coupa system for purchasing. So thanks again to the board for your support on moving those 2 efforts forward. As you know, and I know that this is on the minds of several of our trustees on the board, there will be elections this fall. Nomination packets are available. There'll be 2 teacher trustees as well as a principal administrator trustee positions that are up for election this year. The health insurance rebate, the annual mailing for the rebate went out in February, and our deadline just passed, which was July 31st. Now we're moving to the health insurance open enrollment. In fact, I received a packet of the initial mailings last night. And so the 2025 open enrollment period for health insurance is going to be October 1st through 31st, 2024, with changes taking effect January 1, 2025. So those materials will start to be mailed as early as next week, and then we will get our booklets out following that. We have met with our new team of lobbyists, Michael Best Strategies. They will provide a brief update to the board in just a few minutes. Media outreach, this last few months, we have shared 12 additional news items related to investments, as well as answering several questions from reporters. And then what we do, our member service updates. During the month of June, we had 33 members come in person for appointments, 59 virtual appointments, 13 phone counseling appointments, and we answered over 4,000 phone calls, followed by the month of July, where we had 38 in-person appointments, 51 virtual appointments, 26 over the phone, and answered almost 5,000 phone calls, in addition to answering over 1,200 emails. Our pension reps are extension of getting information out to our members and a part of our communication process. So we send a monthly communication to the pension reps in both June and July to give them information about the upcoming election, stipends, as well as retirement resources. One of the things I wanted to highlight with this report is the progress that we're making in terms of our pension finalizations and our refund updates. We're really making exceptional progress in terms of the processing times. I know we've talked about this in some of our one-on-one meetings. But the average processing time to move from a preliminary to a finalized pension fell to 6 months. And that's from a high of 22.4 months back in 2021. For refund processing in the past 8 years, 34 days, down from a high of 140 days back in 2017. So really making tremendous progress in terms of getting our pensions finalized and paying out our termination refunds. Project Titus, we've hosted on-site demonstrations with our new vendor, TELUS Health, to get a look at what the new system is going to look like in June. Activities for the implementation are underway. We meet weekly. We're starting outreach with our employers to get them prepared for the new system. So during the retirement season, it's winding down, but the estimates are that we'll have over 500 new retirements that we're going to be processing over this summer as we wrap up the retirement season. And as far as our security awareness training, Dan Oaks and myself had the opportunity to present at the National Public Pension Fund Association training. And this is very important because the cyber criminals are professionals. And so one of the things that we emphasize to that group is that employee and stakeholder training is important. So the quarterly security awareness training kicked off in July. It runs through September 20th for trustees. So please complete your security awareness training. The State of the Fund report that I gave last month will now become an annual publication. So looking forward to adding that as we continue to set the pace for transparency among public pension funds. Stakeholder outreach, the House of Delegates, CTU retirees, as well as RTAC were supplied CTPF reports, so they're keeping up to date with what's happening here at the fund. We're planning a town hall webinar for our members on October 24th at 4 p.m. Registration is now open for that, and open enrollment webinars have been scheduled for October 2nd through 4th. In terms of our calendar for next meetings, we do have our Finance and Audit Committee meeting as well as our Investment Committee meeting in a couple of weeks on the 27th, and our next board meeting will be on September 19th. And that concludes my report.
Thank you, Carl. That takes us to 10, report on committee pension laws and administrative rules. That's Quinn.
We're waiting to see if they are online.
You're currently here. Can you see us?
Yes.
Good afternoon. How you all doing?
Well, how's everyone doing today?
Wonderful. So you all be great. Tell us what's happening.
First, we wanted to take this opportunity to apologize for not being there. We are in Springfield for but also Dems Day and GOP Day. So that affords us an opportunity to meet not only just legislators, but party chairs, where they are, and then it's so that conversations can be a little different than that happens in more settings. And so essentially, you can.
We're getting a reverb. Can we fix that?
Okay, hold on just a moment. We're getting an echo, and I don't know if that's on our end or yours.
Can we also make them full screen and take the agenda off?
Mm-hmm.
Thank you.
That's better. Okay. Okay, are we better? Okay, I'm sorry about that.
Can you say something so we make sure we're not still like echoing or whatever was happening? Okay, you can go ahead, Ms. Orr. It sounded like it was still an echo, but we'll see. Over here?
Yes.
I'm not. Is anyone up here?
I'm not.
I'm not either.
Are both of you all connected on Zoom at the same time, or are you all just sharing that space? Yes, so it sounds like there are like Zoom may be coming through on two devices, maybe on you guys' end, or I don't know.
Same room.
Can you all hear us?
No,
They could hear us.
Oh, okay.
we can't hear us.
Oh, I'm not in there, so. Well, the screen just went dark. They just closed the camera, but they may need to disconnect and then come back. True. Can someone maybe message them to maybe, oh, okay. And they're gone. This beard is on fleek. Put some special product in it this morning.
So while we're waiting on them to get the technical difficulties together, let's go, can we go to 11 items to move to the omnibus and the back? What'd you say?
Let's go.
She knew we gotta wait for Cecilia now. Well, you know what? We've been having some short meetings, so we would do for a long, I guess, at some point in time, we're gonna get one.
She said, well, it's not on 203. And Carlton said that's the beginning of the report. Turn a couple pages.
Hello, can you hear me?
Yeah.
Yes.
It's oral only. They just got hired. Yeah, yeah, yeah.
It looks like Mr. Harris is speaking, but we can't hear him. Can you hear me? Yeah, I think it's their internet. Okay.
Okay,
Okay.
now he's unfroze. Can he hear us?
Can you turn your camera off? Mr. Harris, I think that might help. I think y'all connection is, did they go bye-bye?
Okay, he's going to come out and come back in.
Okay, can you guys hear? Can you guys realize? Can you hear us a little bit
Still
better?
the echo.
Woo. We hear you, and it's a serious echo, kind of like Bugs Bunny. Or which one of the characters?
Do they have two devices on in the same room? That's what it sounds like.
Yeah, we gotta move
Yeah.
on.
Okay, so thank you all so much for your time. I will inform the board of Mr. Harris and Ms. Orr about some of the discussion that we had, and then we'll follow up with you all at the next meeting because we can't really hear you.
Okay, guys, we apologize about the technical difficulty. We appreciate that, and we'll circle back around with you guys.
Thank you so much.
Okay, let's go, thanks, Gwen. To 11.
Yeah, let's see what else.
Regarding the lobbyist report, I asked the question, may I ask the question of our leadership, is there a written report that's contained in the executive director's report from the lobbyists?
No, Trustee Woods, we met with them. We've onboarded them now in this last month. And what we asked them to do at this meeting was just to come to thank the board for being onboarded and hired and to kind of talk a little bit about what their plans were in Springfield, but unfortunately we couldn't hear from them.
Okay, so they are new to
Yes,
us?
yes.
And they've been on board since when?
We hired them July 1st and we onboarded them like mid-July.
Okay, my next question then and request then is that we have a written report, whether or not they're in person or not.
That's the plan going forward. It's always to have a written
Okay.
or a report. Yeah.
Okay, and just furthermore, while it's certainly disappointing that they were having technical difficulties, Springfield is not that far. We love the fact that our ED is here all the time. I think our lobbyists should make a priority of being present, especially if they are new and especially if there are two of them. It is a quick drive in a car. It is a quick train ride. And we are certainly in the middle of very precarious times, if you will, as far as our relationship between our legislators and ourselves. And to just put to a finer point, and I'll wrap it up, it's about relationships. And we can't create relationships if we're not in proximity with one another.
Right. And just to be fair, this was planned because it's strategic for them to be in Springfield today. They are normally here in Chicago, but they're in Springfield because that's where the governor's folks are. And we've asked them to do some due diligence in terms of the CTPF TRS issue, as well as some of our other legislation. So that was strategic and planned. And the idea was that they were going to give us an update on some of the things that they were learning while they were actually there in Springfield.
I appreciate that background. That's very helpful to know.
Thank you, Tanya. 11, items moved to the omnibus. 11A, report on committee claims and service credits. Can we move that to the omnibus?
I have my hand up.
Give me one moment. Okay, I'll come back to you. Let me get this. Report on committee and investments. Can we move that to the omnibus?
Yes, you may.
Thank you. Report on the committee of finance and audit. Can we move that to the omnibus?
That
That's
is Mary.
Mary Sharon.
Oh, she might be gone. But we see Serene out there. That's good.
Is she, do you still here?
I guess
Is
I
she
was
still on?
muted, sorry. Move to the omnibus.
Thank you,
Both-
Mary.
Both the report of the Committee on Finance and Audit and the report of the Financial Secretary.
Okay, thank you. Do we have to wait for Lois to come back to? So she can move that to the omnibus?
I think anybody
Claim the
can.
service credit. I don't.
President Blacko, we have a question.
Oh, no,
from
I did.
Maria.
I was coming back to her. I just
Okay.
want to get everyone to move that to the omnibus first. Kim, do we have to wait for, she has to, since she's the chair, she has to.
You know, you could probably take the movement by another member of that committee to
Oh.
the omnibus.
Okay. Lois, can we move your report on claims, Committee on Claims and Services credits to the omnibus? Okay, thank you. Okay, Maria?
Yeah, my question is, has anybody, I mean, other trustees, and I assume you have you looked at the average years of service for people who are retiring? We're getting less and less, and I think it's something we all have to be conscious of and monitoring. The average years of service for retirement are only 20.98 years, or 20 years. And that to me is a concern, because that's telling us what's going on. We don't have those more seasoned teachers that are leaving with 34 years. They're leaving at 20 years. And our pension contributions, they will not be making those pension contributions.
Right.
Salaries are less. Then the other question on the other report, because it's being passed as all, the finance and audit, Executive Director Lenore, if you can help me out on this one. I know a while back I had asked you, and there was the bills for the pension office, utility bills and other expenses were under your name and the American Express card. And we had shared, and we said, because we did not have an IT person that would handle it. Do we have the new chief IT person? When did that person start?
Yes, trustee Rodriguez, the question was, when will we see a split between the expenses from the executive director related to IT expenses? And what I let trustee Rodriguez know is that once we have the chief technology officer in place and our chief information security officer in place, you would start seeing those under their names. And that was effective July 1.
July 1. So these reports are, some of them are June. There's two different administrative expense reports. And one is for June 2024, so I understand. But the next one on page 430 is July 2024. So that chief investment officer was there, because that has been a concern to me, and you and I discussed it, because it appears that those expenses are all yours, but they're utility bills and other bills too. So when will they stop with cease and desist and start placing them on an American Express card? Because my understanding always, when a bill is paid, it, money in, money out. I've never seen it, again, almost 19 years on an American Express card.
If I may, trustee Rodriguez, the
Yes,
cards,
please do.
the cards were just ordered and just came in like a week ago.
Okay.
So the expenses will start in the future reports that you see.
Though they started July 1st, they will no longer be on your card?
Well, they have to be paid right now, but as soon as
Yes, no,
they're
I
up and
understand,
running.
but
Yep.
that's what I'm saying, they're coming and I said, and then they will no longer be on your card. Okay. Thank you. You're welcome, Victor.
No further questions? I need a motion to accept the omnibus.
So
moved.
No, take your pick, Cecilia. Take your pick.
Washington and seconded by Ms. Riley.
Okay.
Okay, thank you.
Thank you, Mayor Shea.
Trustee Barajas?
Yes.
Trustee Beza?
Yes.
Trustee Blackwell?
Yes.
Trustee Nelson?
Yes.
Trustee Ochoa?
Yes.
Trustee Price Ward?
Yes.
Trustee Riley?
Yes.
Trustee Rodriguez?
No.
Trustee Vincent?
Yes.
Trustee Washington?
Yes.
Trustee Woods? What did I call Ms. Woods? Trustee Woods?
Yes.
10 ayes, 1 nay.
Thank you, Cecilia. That is me. And 12A trustee conferences. Does anyone have a conference they want to get approval for?
Just gonna document which ones they want to go to, because it's the.
Okay.
Yeah.
Okay, so we will document one if you find one.
So my plan is to go to NCTR
Okay.
in October. And I guess I'll, communicate with you all for Yes. travel. So we'll have a member of my team reach out to you Okay. on next steps.
I will be in town as well.
Okay. Yes, you can. If there's any that you see on this list
subsequent to today that you would like to attend, just follow up with us and we'll be more than happy to assist you.
We're
yeah.
not sure. Right.
Right, so if you, yes, so the list is presented, we don't have any trustees who need approval, so the list is presented for informational purposes. And if you wish to attend, please feel free to reach out to me, and then we will get someone on my team to follow up with you to, for next steps.
And I think I've already possibly spoken to the team, but I plan to attend NCTR
NCTR
and NCP
and CPERS.
NCPers. Yes, that one as well. Thank you.
And that's when is the
I
NCPERS?
think it's in October, the
Okay.
end of the month.
Okay, great.
Mary Sharon?
Yeah, I noticed we have another section called virtual conferences learning. And I mean, how do we get into those or whatever? Because I noticed Callan College has a virtual one. In fact,
Sure,
next week.
We can assist you with registering for that as well if you'd like to attend. We'll have someone follow up with you.
Yeah, why don't you? Because I need some hours.
Okay. We surely will, and that is for the Callan?
Although I guess I can get hours from the attending Adams Street Conference too. Fernando was going to work on that one.
Okay, so this is one for the Callan, correct, Trustee Riley?
Yeah,
Okay,
the
All
Callan
right.
Town. I don't know which one, but there's two of them listed.
No. this-
One's August 21st and one's September 24th.
October 20.
okay, well, if you decide which one you want to attend, just please let
Well,
us
I
know.
mean, check them out and see how many hours they grant.
Okay. Well, yeah, we can do that.
Please.
We could tell them no. We certainly can do that. Okay. Cecilia, can you make a note of that? Thank you.
NCTR.
NCTR for Trustee Ochoa. Okay.
NCTR for Trustee Woods.
Okay.
I just want to say thank you, Ms. Davis, for placing the virtual conferences, because those are the only ones that I do online. Are there any, I know I've taken some in the past that were free. Are they on? It's not on here? Okay, can you pass them on to Ms. Davis?
Sure.
Yeah.
If you could do that, and then we can share those. We
But
can add
thank you
those.
for
We can
add-
add those to the list and this way and then.
Perfect.
Yes.
I thank you for
Oh, sure.
doing the homework on this. I appreciate it.
Oh, you're
Thank you.
welcome. Okay, sure. Okay. Cecilia, would you care to repeat those back? So we make sure we capture everyone's.
I have trustee Washington, trustee Price Ward, trustee Benson, Ochoa, and trustee Woods for NCTR and trustee Benson for NCPERS. And we will look into Callan College for Ms. Riley and Adams Street.
Yes. Thank you.
Okay, let's check.
Oh. Did she say that?
She don't count. But she used it all day.
That's what I was thinking.
Ms. Davis, okay.
Yes.
Yeah, I had a question. Ms. Davis, at one time, you will remember, we're probably the oldest, more seasoned people on this board. When you had these conferences, you said you can send us the literature on the workshops. Did I understand correctly or I did not? You said something earlier, but I missed it.
If you'd like to receive literature on a specific workshop, we could certainly do that.
Okay. And at one time, we used to have, when there was a conference, there would always be a list of vendors, if they would have dinners and where the dinners were at. There would be multiple events for the conferences. I know at some point that stopped. I don't know why or what happened.
We,
You know what I'm
we don't
talking-
get those invitations. Those just don't come to us, anymore. So
Okay,
we just don't have that information to provide.
okay, thank you.
You're welcome.
I'm sorry. I'd like to entertain a motion to go into executive session
Second.
for what purposes? Litigation matters, executive session minutes, and internal control matters. Did you
So
make a
moved.
motion or second?
Second.
She seconded, she was waiting for you to make.
Oh, I thought you made the motion. I didn't.
No.
I thought somebody else made it, so I said second.
So did you want to make the
I'll
motion?
make the motion. That's-
Okay.
Either way.
Rodriguez made the motion, trustee Washington seconded.
Trustee Barajas? Trustee Beza?
Yes.
Trustee Blackwell?
Yes.
Trustee Nelson?
Yes.
Trustee Ochoa?
Yes.
Trustee Price Ward?
Yes.
Trustee Riley?
Yes.
Trustee Rodriguez?
Yes.
Trustee Benson?
Yes.
Trustee Washington?
Yes.
Trustee Woods?
Yes.
That's 11 ayes.
So that's why I was like, holy crap, so that's why I laughed. Okay. She's in New York and.
Roll call. Trustee Barajas?
Present.
Trustee Beza?
Present.
Trustee Blackwell?
Present.
Trustee Nelson?
Present.
Trustee Ochoa? Trustee Price Ward?
Present.
Trustee Rodriguez?
Present.
Trustee Benson?
Present.
Trustee Washington?
Present.
Trustee Woods?
Present.
Trustee Riley?
Present. I'm on two devices.
Yes, everybody. That's everyone. Okay. 14, approval of executive session minutes. I'd like to, entertain a motion for approval of executive session minutes.
Second.
Who made it? Tammy?
No, I thought
Okay.
I did, but I wasn't on.
And then call the question.
Trustee Barajas? Trustee Beza?
Yes.
Yes.
Trustee Nelson?
Yes.
Trustee Ochoa?
Yes.
Trustee Price Ward?
Yes.
Trustee Riley?
Yes.
Trustee Rodriguez?
No, at this time.
Trustee Benson?
Yes.
Trustee Washington?
Yes.
Trustee Woods?
Yes.
10 ayes, 1 nay. And for clarification, what date are the minutes for?
I'm sorry, I didn't hear you.
What's the executive session date for the minutes?
Oh, what were the dates?
June
20th.
Thank
Oh,
you.
I'm sorry, I didn't hear you.
June 20th.
I'm sorry. Thank you, Becky. 15, unfinished, Courtney, you had something 50.
For, new.
Unfinished business or new business?
New.
Okay, unfinished business. 16, new business.
Yes, thank you, Mr. President. I do have an item for new business. I want to raise an issue that was actually has appeared both in the press several times. We've been talking about it internally. And then this week, several members of the board shared it with me that it was a bargaining point in the recent CTU CPS negotiations. And that is this proposed merger of CTPF and TRS.
Whoa.
Clearly, this is not the first time that we've heard suggestions for this same merger. It's been raised periodically in the past, most notably when CPS has a budget crisis. While we have not had this item on our agenda for action and we can't vote on anything today, I do want to reassure you that as an organization, we are working behind the scenes on this issue from many angles, and we take these suggestions very seriously. I also want to reiterate that as we have in the past, CTPF will stand unequivocally opposed to such a merger. As fiduciaries of this fund, a merger would not be in the best interest of our members. While we will not vote on this today, as I look around the room, I'm sure I see your heads nodding in agreement, that we will take action to move forward with our legal team, our communication team, as well as our legislative teams in outreaching our opposition to a merger with TRS. CTPF has operated as an independent organization. We've been self-governing, self-determining for over 130 years next year. We have set the standard for a high-performing organization with excellent investment returns, an elected Board of Trustees with values, and provides opportunities for our minority, women, and disabled business enterprise investments. We are the oldest pension fund in Illinois, and the second oldest in the nation, whose stewardship ensures our mission is accomplished, which is that we provide, protect, and enhance the present and future economic well-being of our members. CTPF can do that best, and will continue to do so. So I appreciate your support and your guidance on this issue, and look forward to sharing more information as we progress. Thank you.
Thank you.
Still under new business, I would like to request that CTPF management write a resolution appealing any type of consolidation or / merger which with TRS, or any proposal which may mirror a consolidation or merger. If I can get a second.
So we don't have it on the agenda to take action on, but your comment can certainly
Right, and it's
stand.
piggybacking on what you're saying, but I'd like a commitment and I would like a roll call vote. May I get a second on this?
Actually, you can't take any action on it.
You can't.
You could certainly ask for comments, but you can't take a motion, second, and action.
Yeah. Okay, so because it's new business or?
No, because it's literally not on the agenda. You can only take action for things that are on the agenda.
All right.
But you can talk about it, so if you wanted to ask others to
Yeah.
share their feelings.
Tanya has her hand up, and then
I'm sorry?
Lois. I said Tanya had her hand up and Lois had her hand up.
I have mine up too, Jeff.
And
Okay.
I'll comment last.
I'm sorry.
I'll yield to her, allow my fellow trustee to finish her comments, and then I'll make my comment.
Okay, I get two other
That's
comments,
okay.
so I have to. hear
Whatever
them
order you
first.
wanna take.
And then, but you're saying you want to go last?
No, it doesn't matter. I'm just saying, I'll yield. I don't need to start talking right now.
I'm trustee.
Okay, let me hear the other two comments, and then
Trustee, I am done.
Lois, and then Mary Sharon, then I'll come back.
My comment is a concurrence with the letter that was just read, because CPS has rated our pension fund twice. And whenever, as was stated a minute ago in a comment, that whenever money is needed, that seems to be the first place they look. So we do not need to be with TRS. Our board is very different from TRS, which is the teachers' retirement system, which is the suburbs. And I say that in case someone isn't aware, that we are 299, District 299, solely alone, Chicago teachers, only Chicago. So at any rate, I just simply want to put it on record that I concur with the letter that we're, that is being looked into and it's being worked on. Thank you.
Mary Sharon?
I have a question. What would be bad about being with TRS? Their benefits are the same.
The benefits are not the same.
Yes,
Mary
they
Sharon.
are.
No, they're not.
No, they're
They're under a
not.
different section of the pension code.
Thank
No, I
you.
realize that, but I'm saying, we were 1895. TRS didn't start till the 30s.
1939, yep.
Yeah, and, oh, that's right, you know about them. You can answer the question. What would be different?
So we have put together a strategy document, but just some of the highlights of it, Mary Sharon, include
Yeah,
the
that's
fact
what I
that
need
we
to know.
are a better funded plan at 40, almost 47%, where they're hovering around 40%. Our investment
Oh, really?
returns
Okay.
historically are over 8%, and they're teetering around 7%. We have an elected board,
Don't they?
two elected out of 15 on TRS's board.
Really?
So
Okay.
our members have a voice here at CTPF. And who better to decide what happens with Chicago teachers than people in Chicago and not Springfield, 200 miles away?
Right. Back in the day, though, it was thought it might be a good idea. I'm talking before you, Maria. But
No, well, Mary Sharon, back in the day, before 2000, it was not a good idea.
no,
So
I'm
perhaps-
talking the 90s.
I get two more
And
comments.
at that time, it was considered a good idea because we hadn't been rated yet, or we were just about to be. So it's a different time.
Thanks, Mayor.
Okay.
Tanya, did you want to go or do you want Jackie to go?
Yeah, I'm fine to go. I just want to say I acknowledge and receive and hear the statement made by the executive director and know that it is certainly not the position as CPS nor the Board of Education to make this merger one of first resort during a crisis, although it certainly may be experienced as such. But the board is looking at a multitude of strategies to address any budget shortfalls or gaps. This is not the first time that a merger has been discussed, nor should we, you know, I appreciate my fellow trustees bringing up some history lessons. And so we should be mindful of this is probably something that does come up and not coincidentally when there is a crisis. However, it's not the first time. And I'll continue to ask or add rather that type of analysis of, as Mayor Sharon put it, what would be so wrong about it is that we continue to keep at the forefront what the comparisons are for the key and essential elements, whether they be pros or cons, so that as the conversation about a merger may continue or arise in the future long after we're here, that there is a record of the factors that were considered by this board at this moment in time and can serve as future information for future boards and trustees that may have to consider this same issue in the future.
Thank you. Jackie, close that. Oh,
Okay.
Jackie, then Victor, then we out of here.
All right. As that statement was made, it really, as a matter of fact, Trustee Vincent and I were sitting at the same computer, and we are in open bargaining. That was the number one solution to solving this $2.9 billion deficit with consideration of contract demands. That's at the top of the list. And it was received as a shot across the bow. And it was also commented on at open bargaining as such. And because there has been proven with these toxic swaps that those were illegal. And they were asked unequivocally to get on board with coming together as a CPS and CTU to get that money back. That's our money. That's the kids' money. And so the interest that we're paying on that $200 million every what, month or so, because of they sold them for cheaper and now they got money off of it and we paying the interest on it. So that's why it was just rather offensive. And yes, I did.
Yeah.
I sent that information to executive director and commented on it. And I said, this is one of the solutions. So there are many solutions, but none of them include going after the people who have our money. That's why I felt it was important, because that was first on the list.
No, but we have to hear all the sides to the story so we can argue them. And remember, if we had the 3.2 billion that Mayor Daley stole from us, we'd be in a whole lot better shape.
Victor? Oh, to your mic.
Every representative of teachers, whether retired or not, or the principals, nobody is for a merger. Nobody. So it's just that simple. It's that we're all on the same page there. Let's just make sure that's clear.
We just want to know what the arguments on both sides are so we can defend ourselves.
Yeah, then make the motion to adjourn.
Okay, got you. So, and this is a question for Executive Director Lenore. Maybe you could explain this to me, like, I mean, what would be the point of a merger? Like, where's the money gonna come from? Because as it stands, Chicago's already paying for Chicago.
And some are downstate.
Right, and
Okay.
so, because we're paying twice actually in Chicago,
Yeah,
so,
because we pay state taxes.
right,
Yes,
and
we do.
so how does that benefit the city, or how does that benefit the state?
Let me,
So one of the proposals out there is that the tax levy that got restored in 2016 would be used by CPS for operations as they did back in the 90s. But
95.
but instead of that being the end of it, the entire fund, including your control over the board, would all go to TRS, and then that the state would start making that contribution. Well, if the state can make the contribution and send it to Springfield, they can send it to Chicago.
Right.
So that is the point that we're making. These are the same dollars. Our liabilities do not diminish when they get to Springfield. They're still going to be the same.
Mhm.
But because
And
we're
we're-
higher funded, because we have
Wait,
higher
wait,
investment
wait, wait,
returns,
We're the
we're
only
less
school district that
expensive.
doesn't.
Mary,
for
wait a
our
minute.
liabilities.
Oh, I'm sorry.
Mary, we
I
trying to
can't hear.
listen to this, okay? Thank you.
Because we're higher funded, because we have higher investment returns, we're less expensive for the state than when those liabilities would get to TRS.
Because everybody's pension is paid by the state but us.
Yeah,
Right.
that's what I
Okay,
was
but
saying. Yeah.
us. So they're saying combining it so that will alleviate CPS from having to pay the 7% and we pay the 2%. They don't want to do that anymore because they want to keep that money in their coffers.
Bless their hearts. Well, can I make a motion to adjourn?
Please.
It should be a long conversation.
Can I get a second?
Apparently, some
Second.
folks don't know.
Thank you.
some of the
Motion was made by
facts.
trustee Washington, seconded by trustee
Roll
Riley.
call, please.
Call the order, come on.
Trustee Barajas? Yes. Trustee Beza?
Yes.
Trustee Blackwell?
Yes.
Trustee Nelson?
Yes.
Trustee Ochoa?
Yes.
Trustee Price Ward?
Yes.
Trustee Riley?
Yes.
Trustee Rodriguez?
Yes.
Trustee Benson?
Yes.
Trustee Washington?
Absolutely.
Trustee Woods?
Abstain.
You want to stay all night, huh?